Hello and a very big welcome to everyone. Now, just before we start, as you know, we here at Your Property Success love to spread the word about low risk, no nonsense property investment to as many everyday Australians as possible. And so often these calls contain some really great content and questions that would be extremely helpful to the other people, which is why we record the calls and reserve the right to share the content down the track. So by participating in this call, you are acknowledging this, and if for some reason you prefer not to be included on the recording, we just ask that you contact our office within 24 hours and we can edit you out. Welcome to our Hotspots 2016 webinar. Now, as a student of history, I see everything happens in cyclic patterns, and it's no different with the property market. There has been volatility in global markets, confusion in our property market regarding interest rates. Rental stats are up in Brisbane and Hobart, down in Perth and Darwin, and there's no change in Melbourne and Sydney. Goodness, what does it all mean? Will the property market continue its meteoric rise, stabilise, or are we in for a short-term slump? What I do know, and which history has taught us, whichever way it goes, there are opportunities for those who can read historic cycles and patterns. In some areas, we are seeing an oversupply that will have an effect. In others, great investor growth potential. The trick is to know which ones. So I felt this was a very timely time for us to come together and take a look at the opportunities that now exist and will exist in 2016. But first, let us look back at 2015 to review what occurred, where we are now, and together with two of Australia's top property investment commentators, present our analysis enabling educated predictions for 2016. Then we'll open up the lines for you to be able to ask questions. So it's going to be fun and an interactive session. So let me introduce our panel. Ben Kingsley is the founding director of Empower Wealth and chair of Property Investment Professionals of Australia. As a qualified property investment advisor, Ben is one of Australia's leading experts in property investing for wealth creation and is regularly featured in print, radio and TV, including on ABC News 24 and Sky Business News. So let's bring Ben Kingsley from Empower Wealth to assist us today. Ben, your team of buyers agents are working nationally based on your advice. So there's no one better to tell us what has been happening and what will happen. So can you tell us what's been happening on the ground that you've seen in the past year?
Yeah, g'day Jane. It's been an interesting year. There's been places that we thought may have come good a little bit quicker than they actually have. We've seen obviously the bigger national markets of Sydney and Melbourne continue to surprise a little bit on the upside in terms of just how far they've gone. But we are seeing, I suppose, trends around that in the sense that when the market moves, it's moving relatively quickly in a short period of time, whereas traditionally some of those cycles have been a little bit longer, but we'll talk about that later. Obviously, I think it's probably the takeout of 2015 for me has been the economic activity in a particular area. I mean, we're a big believer in economic activity, but you know, if you sort of listen to anything I've talked about in the past, it's human interest and human behaviour is the real interest case for me. So I'm interested in owner-occupier appeal. I'm interested basically where owners want to live, where they're emotionally charged with their wallets and they buy with that emotion as opposed to with their heads, which is what a good smart investor should do.
And I guess, you know, if over 70% of the market really is owner-occupied driven, it makes sense that if there's going to be growth, it's what the owner-occupiers are going to connect to.
Yeah, I mean, that's right. I mean, they are the price makers and investors should be the price takers. It's obviously when that gets flipped around the other way where you do see mining towns when they do have those, you know, relatively high runs around shortage of supply, high demand, and you see these skyrocketing prices, but you also introduce volatility in those areas. And that's because they fail to pass the lifestyle test, which is, you know, if the job wasn't there, you know, paying me $125,000 to drive a truck, I wouldn't be there. So, and that's what we're seeing, you know, when those jobs dry up, everyone leaves the community. So that's where you are exposed. So from our point of view, we're not, you know, big on those types of centres. We like the sort of long, sustained growth, or depending on what our clients' needs are in terms of if we've got to chase a bit of yield, we'll go and find those areas.
So it is a completely different story now at the beginning of 2016 to where we started in 2015. So I guess thinking back to the beginning of 2015 and what you were predicting, what did you get right?
Well, I think we got the pockets right in terms of the markets that we were focusing in on. To say Brisbane or Melbourne or Sydney or wherever, I think is a bit generalist. For us, when we're looking, and I do have the luxury of having, sort of 6 people who are looking pretty much full time in our business. We've got the 5 buyers agents and one of our assistants in there as well. So we're able to, sort of 24/7 keep an eye out on what's happening in the sort of more granular places in the market. So I think we've done well in terms of, I suppose, getting the bottom of the market in some areas around Brisbane. We've bought mainly units and townhouses in very particular suburbs, very sort of high-end suburbs where we think that there will maintain a shortage. We bought the odd house there as well. And Melbourne, we've been cherry-picking certain markets where we feel that from a convenience and proximity and transport and those sort of modern needs that we have around timed efficiency, we think we've sort of done well in terms of securing the right type of land in some of the western areas and some of the pockets of the northwest and the like in there. And I think they're sort of been the 2 markets. We stopped buying in the Sydney market around sort of early in 2015. We'd done quite well out of what we'd secured for our clients in that market. We didn't make a lot of purchases in that market, but we did well for those ones we did make. And they've sort of been the crux of what we're doing. There's been a bit of speculation in a couple of other sort of far north Queensland areas that we've also been seeing whether we're at the bottom, and they're a little bit more speculative and a little bit more yield driven. We just think that there's some upside with the low Australian dollar and sort of some tourism arrivals that we think will assist some of those markets as well.
As you say, you've got your analysis and your buyers agents out there, and it really comes down to the buying criteria of your clients, doesn't it? Some people are happy for a little bit more risk and being speculative, and others, want to keep to the blue chip owner-occupied type investments.
Very much so. I mean, we talk about it in terms of the household income and what's available from a surplus point of view. Usually, our preference is to buy growth assets and set and forget assets. But again, it comes down to the brief. We've got clients who want value add, ugly ducklings, reliables and durables, those types of renovating rescues. It really is horses for courses, and I think that's also a sign of the maturity of the industry. People like yourself who are coming in and educating so well those types of people who want to equity harvest. And that's again a sign of maturity of what we're trying to do in terms of wealth creation in the property investment space.
Now, it's interesting you mentioned income surplus. Is that one of the things that you look at that drives a good market? What are you looking at when you're trying to pinpoint for your buyers agents where to start concentrating their time and efforts?
Yeah, I'm a massive fan of household income and analysing that household income. We spend a lot of time in sort of looking at the granular levels of income. The analysis work that we've done, it's slightly different than the way you hear people talk about the share market, and the great quote is, past performance is no guarantee of future performance. Well, we've got data that's, we've got a lot of data that's 25 years old, and then we've got some data that's now pushing 40 years old in terms of area analysis. And some of that data, there is, for whatever reason with residential property, that the historical performance is actually a very strong indicator of future performance. And I think that speaks back to the story of that sort of human interest and human behaviour stuff. I mean, we're not creating any more land. The same story principles apply. If it's a safe area, if it's full of like-minded people, upward professional types, then the reality is that those people's incomes grow quicker than the incomes of people in the outer fringe suburbs. And so for us, that gives us the security to know that we're buying in low volatile markets. But it also says to us that, they're the people. We saw the forward projections of income for 2016. It's saying that between 1% and 2% income growth this year. Now, that's obviously the national forecast, and that's because some areas are doing it tough. But there's going to be some people and professionals who get 6, 8, 12% income increases. They move up their tier of professionalism, whatever it may be, and they're clustering together. They like to congregate together. They like to send the kids to the right schools. And so that's a big part of the demographic profiling that we like to do.
We all kind of think that we're individuals, but we're not, are we? We follow the pack.
No, we do. We're a bit sheep.
Ben, can I twist your arm and maybe get you to share with us some of, I guess, your analysis that you're doing around income? I'm sure you've got something there that you use.
So this is our location analyzer, and again, as buyers agents, our clients pay us a very handsome fee for the work that we do, in the obviously goal of getting the best performing result they can. So we spend a lot of that money and reinvest that money into the research that we do around the different areas. So we've got it's effectively a geospatial platform that allows us to do that, and it maps out borders and boundaries from whatever types of determinations we want to map out. So that could be median house price, it could be clearance rates, and that type of thing. So I'll just give you a little sneak peek by hitting the map.
Very exciting here.
On Melbourne, you can see that now what I'm doing here is having a look at sort of the clearance rates by area, and you can see the time period from 2009 to 2016, so a very extensive time period. Now you can see, here as an example, Little River, it's an interesting one, and some really dark ones, which is telling us it's had 100% clearance rate, but the reality is over that time it probably represents about 2 auctions in that period, because obviously it's not areas that would normally do that. So we would then filter down through these, and you can see by me clicking on a couple of these data points and areas and suburbs, I can also instantaneously get the sort of growth rates that have been occurring in those particular markets. So obviously some of those inner city, a really beautiful sort of 60-degree curve there. And if I push out to some of the sort of more regional areas or sort of city fringe areas, the growth rates have been considerably slower in terms of what's been happening in those types of markets.
So I'm just looking at, you're showing us the graph on the left-hand side that's actually superimposing on the map there, just a little bit light. Can you just explain what I'm seeing there? Oh, so the different suburbs that you're selecting on top of each other.
Yeah, they're the suburbs, so that's right. I've just basically grabbed the house for median, and you can see, so here's Tenant sort of more on a sort of maybe a 30-degree angle, so slower growth rates, and then you can see obviously some of these Ascot Vales and Richmonds and so forth. So I'm able to just quickly have an assessment, and I can time map that as well, or date stamp it to sort of look at when I want to look in that area. And as I fly over these areas, you can also see on the right-hand side of the screen, I'm getting instant median price, growth rates, rental yields, income, affordability measures, days on market, stock on market indicators as well.
I'm impressed. I'm impressed, Ben. Show me the income information.
Yeah, I think that's the most important thing if we wanted to come in. So I'll just click on the income. So one of the interesting things around income here is we've built this to sort of show us low income levels and high income levels in a sense. And so for Melbourne as an example, if I click on this particular, I need to put Melbourne as in a location, my apologies.
Just SA1 there, just for everyone else, is the census way that they actually defined an area, isn't it?
Yeah, it is. So it represents about around 160 dwellings. So if you wanted to get a good sense of where the rich people live in what streets, this is one of the perfect ways to do it. It takes a long time to build it out, but once you do, it's fascinating in terms of the insights that it's able to provide us. And of course, this is the 2011 data. We know it's an exciting year for us analysts because we get census data and we get that in early 2017.
Yeah,
so we're hoping that everyone fills their census in. Yeah, exactly right. A little bit of a wait, but you'll see that sort of information coming through. So I'm just waiting for this to load. And so here it is here. So what's fascinating about this, and I'm just sort of driving in, it's going to take a little bit of time. It's working a bit overtime here. So you can see all of these areas. So this is obviously Tirac showing all this dark red, sort of burgundy colours. So that's showing that the percentage of the population in some of these sectors, so this sector here, this sort of street pocket of Tirac, 26% of the people of the households have got over 104,000 in household income. You can see the Middle Park and Albert Park areas. And as you get wider, you get a lot lighter. So again, even if people want prices to move in certain locations, people have to afford to be able to buy out in those areas. So, you know, it just gives us a good indication of where those changes are. And if you overlay, say, 2006, 2001, 96 and 91 on this, you can start to draw correlations and trends around where the income's changing, and then cross-reference that to, say, price growth as an example, to sort of see, you know, how reliable that is as an indicator of growth. And we think it's a pretty good one.
So I guess that takes me, and thank you so much for sharing that, but I guess
That's all right.
that takes me to the next point. I mean, you said you kind of pulled out of Sydney early 2015 and cherry picking Melbourne, and you've been doing Brisbane. So what, I guess, influences you to pull up stumps and move on to the next state? And obviously we're keen to hear where that is, but what are the big things that have had you move on?
Yeah, I think the big one at the moment has been supply. So the supply story in some of the markets is my biggest worry. So, you know, when you see off-the-plan apartments, you know, pre-sales happening nicely, traditionally developers get ahead of themselves, and so now that's obviously not in freestanding houses. They will continue to do fairly well, but if you're talking about apartments, you're going to see some real challenges in that medium and high density markets around Melbourne, Sydney, Brisbane. So they're markets that we just say, look, and we haven't stopped in Brisbane. I think what we're doing is we're just continually refining where we feel the market's at and where the interest's at. So we're still buying in Brisbane, and there's still certain pockets of Brisbane that we like, you know, without sort of drilling right into the suburbs. I think if you're within 7 kilometres of town and you're getting your property on its own title, or you're one of 4 or something along those lines, you can I still see value in that because of the scarcity element to it. But if you're buying into the medium and high density stuff, you're in a bit of trouble, and that's similar to Melbourne. So we'll continue to keep buying, seeing opportunities in those markets. So it's not as if we don't stop buying there. I mean, I use an assessment to sort of say, in Sydney, anywhere between sort of 400 suburbs are always on our watch list. In Melbourne, it's like 300 suburbs, and when you've got a tool like this, which is analysing 15,000 suburbs and can effectively get it down into street level, you know, there's the ability to aggregate data fairly quickly. So, you know, when we're making decisions about exploring new markets, it's a combination of the supply story and also just where the sentiment's at, in terms of if we've seen some substantial growth. History tells us that we get a little bit overexcited, and we normally see a correction at the top of the cycle where we give back a little bit of those gains. In some markets, 5%; in others, as much as 10 or 15% if it's been a 40% run in that suburb or something like that. So we're just trying to keep refining our skills around where the timing of the market is and where we see opportunity based on. In most cases, we're sort of moving from in affordability circles. But even for the wealthier areas, we're still saying, does that constitute affordability based on the incomes of the demographic of the people who live in that area? Because we might think that $800,000 isn't affordable, but if that area is saturated in professional managers and white-collar workers with tertiary qualifications and 6-figure salaries, well, in all honesty, that scarce asset could still be good buying, especially in the sort of what I would consider a softish market, or where buyers' interest is only just starting to prick up.
Absolutely. It's interesting, isn't it? I mean, if we've got people with that kind of demographic that have a 6 to 12% potential increase in wages, then it leads to the belief that area can still have some legs to it.
Yeah, that's right. And I mean, I've presented on those types of cases, and myth-busting stories around, will these really good areas continue to keep growing? Well, our data's telling us they will. The thing is, you just don't want to be buying when the owner-occupier is in there in a frenzy, because you're going to be caught up in that. So you want to try and buy counter-cyclical to their interests. So as people start to say, oh, Brisbane, or the people in Brisbane wake up and say, hi, honey, we're ready to upgrade and we're ready to get into that market. We need to sort of probably predict when they're about to do that and before they do it in the droves. Because, again, you only need 3 or 4 households looking to buy, 3 of those missing out each weekend on a property that they've been waiting to come up, and all of a sudden you get these impatient buyers, and again, they buy with their hearts, not their heads, and that's where we don't want to be wrestling with them. We want to sort of be in that market before they get there.
Before they realise that they want to upgrade.
Yeah, so in some cases we're buying maybe 18 months or 24 months before the markets. Everyone's sort of talking Perth down a little bit at the moment. Well, it wouldn't surprise me if we're not running the ruler over Perth by the end of this year. Even middle of the year we'll start analysing it. Canberra's another one where we'll start analysing and sort of say, is it... We love the fact that sentiment's a little bit shy because that's when we can negotiate well, as opposed to, if it's a true buyer's market, even some of our best tactics as negotiators fall on deaf ears if the buyer has, or if the agent has 3 or 4 buyers lined up.
What's going to happen in 2016? What should we know, and where should we kind of be casting our eyes that 18 to 24 months out?
I think certainly marketplaces that have been depressing. I never thought I'd mention the Gold Coast, but I think I'm on record on the Gold Coast 10 years ago to say I'll never buy on the Gold Coast because the challenge with the Gold Coast and the Sunshine Coast is industry and the wages that are generated out of the industries there. So when those areas are booming, when we've got really strong population growth and migration growth, your biggest industries are your construction. So plumbers are earning 150,000 a year, and the kitchen manufacturers are flying, and everyone's doing really well, and the money's a splash, and there's lots of money coming from Mexico, south of the border, from Sydney and Melbourne, for property investors who are being hooked into this sort of dream story, because it does pass the lifestyle test, but once it all settles down and the tide goes out, we can see, as Warren would always say, who's swimming naked. So that's the cycle we're in. So I think we're coming off the bottom in those areas, and there's the light rail project that's happening through the Gold Coast, and the real focus on trying to get FIFO into that marketplace and bringing a little bit more higher income. It's a little bit more sporadic, and you've got to be careful in what you do there. But if you were cherry picking the bottom entry level assets in those locations where you might be 25% below median for the suburb, I think you'll probably pick a market that's probably got about 2 or 3 years of growth in it, and then we'll start to plateau. So, if you were timing the market, Sunshine Coast and Gold Coast would be something to run the ruler over, because vacancy rates are pretty tight, yields are still holding up. Okay, so if cash flow is still important to you, there's some marketplaces that you'd look at. We're, sort of buying very clear cut strategies in Adelaide. We're focusing in more on sort of what we would call rarer items, which is period type properties at the moment. So it's very selective in terms of what we're doing there. In less than 25 suburbs are of interest to us. Now the difference with Adelaide is their suburbs are so small. You can almost fit a suburb, kilometre. That's a suburb, and some of them are even half a kilometre. So that their sample sizes are hard to read sometimes. So you're thinking, oh, is that a suburb? But the reality is when you're looking at one suburb, you can't be naive not to think that you need to spread your search within that sort of borders of those types of suburbs.
Yeah, it's interesting you mentioned Sunshine Coast and owner-occupiers kind of driving a bit of the market and showing interest. I think in the last week I've had 2 or 3 people talk about wanting to buy and move to the Sunshine Coast to get employed at the new hospital there. I know you and I are both big fans of having infrastructure to help charge growth as well in areas. So it's interesting to see that people are already looking there to live and work. Yeah,
and it's that migration story. So if we actually have a look at the last big cycle for Melbourne, Sydney was 2003, 2004, and then sort of Sydney stagnated for a while there, but Brisbane came alive in 2004, 2005, and part of that story was that migration story of, Sydney's just getting too tough, it's getting unaffordable, I'm still commuting an hour and 20 minutes from the suburbs to the city to work, this is just not a living, and then they go and, you know, in the past, the last 4 or 5 years they've been jumping on planes because the dollar's been so good and travelling overseas to Bali and the US. But now, if they're going to jump on a plane and go and check Noosa out or check the Sunshine Coast out, Alexander Headlands, and come back and go, you know what, wow, that was really interesting. And, you know, you can ask people up there. I was fortunate enough to be up there at the start of January at a conference, and, you know, talking to the locals, so when did you move here? 20 years ago, right? And what happened? I had a holiday and never went home. Or I had a holiday and backed up. So you're going to get that type of population, but again, it's still critical to make sure that the incomes come with it. So when you've got a research hospital or a training hospital, when you've got those types of things, you're going to get some slightly better. And if you talk to the council there, I was fortunate enough to listen to a presentation from them, that, you know, they are really interested in bringing industry into that particular marketplace, because the reality is, and again, this is probably what Adelaide generally struggles with, is the brain drain. Most people, if they want corporate careers, are pushed into the Melbourne and Sydney markets. There are two big centres, and that's where the big salaries are earned. So from that point of view, you know, you can never lose sight of our two mega cities. But if you know, government and industry can be attracted through incentives and held in those locations, and you might see, you know, a movement of brain talent, because business needs the best and brightest to run them. Yep. And if they get, you know, if they've got a limited pool of best and brightest or clock watchers, which is sometimes what, you know, for Brisbane, where it's 5 o'clock, oh, it's got a great lifestyle, so I'm going to sneak off out there.
Hit the beach.
So they've got to get past that. Yeah, they've got to hit the beach. They've got to get past that to sort of be that absolute blue chip location. But again, you know, there's opportunities in each of those marketplaces.
Absolutely. And I guess it brings me to Perth. You mentioned that right up front, saying, you know, it's something you might run the ruler over. I mean, they've obviously had the big hiccup associated with the commodity prices there. Is that going to be, you know, we're looking at a low Australian dollar and not a lot changing, I gather. So is that going to be a rebound based on another economy, or do you think we have to wait for the commodities to come back?
I think you'll find that, again, Perth has a pretty good lifestyle test. So, but I think their wages growth will be something that will slow down. So that's the big thing I'm going to be looking at in terms of, you know, unemployment, wage growth, supply. So they still might have some headwinds, but again, some of the best buys you can make is in the times of trouble. The question is, yeah, how quickly can they reinvent themselves? Now, they've got a fairly detailed infrastructure program over there. You know, Burswood's getting some development. You've also got potentially the new sports stadium that's going to be built. Their rail network is getting more sophisticated. So they're doing some positive things to retain people. And again, if you can handle the heat, it's a pretty good place to live from a lifestyle point of view. But I think you will find, yeah, that the world from a commodities point of view will need to time itself. So just because we're running the ruler over it, we've got to make sure that that economic story is a real positive one. And if we can't see that, that's going to be, and you know, coming back to Brisbane, that's really why the rubber hasn't hit the road as strong as we would have liked to hope. You know, Campbell Newman took a lot of the public servants out, which created a sort of a bubble effect in the employment side. The commodities, it's also a commodity state. So from that point of view, we want to have confidence around industry and what's happening in small and medium businesses there, and what the current Labor government are going to be doing about that, and look at their forward forecasts on economic activity, and then sort of say, generally speaking, you know, we're more bullish on some other parts. But I still think there's buying opportunities in those areas when you get down to the granular case-by-case type stories.
It's the pockets, isn't it? It's not the big story of one city. It's a lot of pockets of potential within the smaller areas. So Ben, we've kind of skirted around the big movers in 2015, Melbourne and Sydney. So what are your thoughts? What's happening in those markets in 2016?
I think it's going to be a markets within markets story there, very much. We're seeing trends. The real interest in terms of demand is still focused around bedroom contents of 3 and 4 bedrooms. So in the sort of really rich areas of the inner east, townhouses, villas that are going to hold, but effectively would be $300,000 or $400,000 cheaper than a house. in some cases even cheaper again. So you may not get as big a land content, but people are deciding on location over that land content as long as it meets their needs, because that's where the scarcity lies. So I think if you're running the ruler over Melbourne, anything where you can pick up closer to the city, 3 and 4 bedroom accommodation, namely houses, townhouses and villas, there'll be some good buying there. I'd be steering clear of medium and high density apartments. There will be real pockets of oversupply in those markets, and I think similar is going to be the story in Sydney. I mean, that marketplace, the economy is absolutely booming there. I think it generated something like 60% of all the jobs in the second half of last year across Australia. So that is a very, very busy market, and I think that some people are calling the top of the market. I don't know whether we're at the top, but I suspect we will see that whatever's going to happen in terms of some of those outer fringe areas. I'd be careful, even with the house and lands out that way, and coming into town. Well, there's no better harbour in the world, so that scarcity will remain. And I suspect if sentiment remains strong and job security is good, you'll see wage growth in that particular market, and I suspect you'll see still some of those areas surprising even the likes of me in terms of some continued growth, or if anything, I think they'll flatten, but I don't think you'll see too much of a correction again unless you're in that sort of medium and high density stuff where I do feel that people have paid overs for that type of accommodation, and I suspect we'll see some media reports changing the sentiment around the market based on those apartment accommodation.
Ben, it kind of brings me to what we kind of touched right on the beginning, which is that cyclic nature of property. And you mentioned, the 20, 40 years worth of data, the historical performance really does give us a good indicator of what's happening. But you and I, or everyone's seeing that the property cycle seems to be getting shorter. And, we're hearing that we're seeing the stats and the clearance rates, etc., to indicate the eastern states are slowing down. So do you think that these, shorter market cycles are the new norm, or is it the fact that this is just a bit of a blip now and we will settle down? And if so, when do we start moving up again?
Gee, I'll get my crystal ball.
There's about 5 questions in there for you, okay?
Yeah, there is. So let's start with the cycle changes. What we've seen is sort of unparalleled. We're in uncharted territory as a nation. We've had positive economic growth. This is the 25th year that we're seeing positive economic growth. Some of the children and the Y generation, they haven't seen a recession. They don't know what it's like to live with 18% interest rates, and they won't actually get to see that. But what I'm pointing out there is that when you've got such a long cycle of that, and then we saw a GFC hit, we've been, the world has changed in regards to the way in which these cycles have moved and the incentives that we've been introduced into the property market, which is usually lower interest rates to try and stimulate that growth. So these asset appreciations that we're seeing in the cycles that we've seen lately are probably that as a cause and effect, as opposed to if we had seen the world continue on and steady growth as opposed to the bullish global growth we saw, we probably wouldn't have had such tight cycles. We're coming, because we've had such amazing capital growth, the yields have been the lowest they've been, the growth in yields at the moment, the lowest they've been in 10 to 15 years. So I suspect we will see a period where, generally speaking, across the board, we're going to see softer capital growth. And I don't think that's a bad thing. You just can't sustain this sort of rising tide. Yeah, this rising tide lifting all ships. And I think once you see interest rates maybe getting back to their more long-term average, and we work on long-term averages for the listeners, we work on long-term averages of 7.25%. So since 93, when the Reserve Bank was decoupled from the federal government and independent, we've seen interest rates hover around that sort of 7% range. So when you're doing your numbers and you're doing your calculations, that's the sort of number. Now, we've seen historical low interest rates, lower than the last 50 years or 47 odd years or whatever it was. Now, this is uncharted territory again. So I think what the message there is that we may not even get up to sevens, because some households might be so highly geared that at 6% it's starting to hit the family budget, and so the Reserve Bank won't have to, I suppose, adjust that monetary policy as hard, because they'll be seeing a slowdown in the economy. So, we need government to do more in the infrastructure side of things. We need potentially some of our pension funds and super funds to do joint ventures and get some of these east-west links and these road and rail and serious infrastructure to be built. Speed, if we have a fast train, that's a game changer for markets like Albury-Wodonga. It's a game changer for markets like Canberra. Imagine living in Albury-Wodonga where, you can be in Melbourne in a matter of 50 minutes, travelling at 600 kilometres an hour. I mean, in terms of lifestyle drivers and people wanting to be up there and, golf courses and ski fields and all those types of things, that would influence people. The reason why we congest ourselves so close to our CBD locations is because our transport infrastructure, like most other big developed cities around the world, struggles to move population masses quickly. And so we just get impatient, so we gravitate to the infrastructure and the lifestyle elements and the rest of the bars and all those types of things which, make life worth living because we're so time poor these days.
So you think that I guess the monetary policy is pretty much going to govern itself, and as long as we sustain the way we're going, and I guess as we've seen with APRA and ASIC changes, there has been some forward thinking there in what they've done in having us pull back on some of the lending. So in 5 years' time, we don't have that mass sell-off when everyone can't afford it. So all in all, good news, I guess, that's happened. But looking forward, you're suggesting that more of the same and some growth opportunities ahead.
Yeah, look, I think it's really important to understand 9.5 to 9.6 million dwellings growing around at the moment record levels of 180 to 200,000 new dwellings a year. So, where our market is challenging because we've got to try and pick a handful of those assets every year. So, from that point of view, that's why I suppose I don't get too caught up in the macro, and I do like to study the classic indicators, which are the supply into suburbs, which is available on the ABS. You've also got, days on market, average discount. So some of the traditional type of indicators, clearance rates, those types of things still have their bearing on what we're looking for. And then if we overlay the science around what is the scarcest assets going around, it's really, 3 and 4 bedroom houses, as long as there's not a lot of vacant land around you. But if you've got fully utilised land and you're seeing new suburbs being developed or backfill going in next door, and you see an opportunity to renovate that and you've got the budget to do it, well, you're going to equity harvest really nicely, as part of following your strategy.
I was going to say, I love a renovation. Ben, I'd just like to thank you for being with us and sharing your expertise. And I've really taken away quite a few notes here. I've got owner-occupier appeal and, looking at that income driver and some of the things that you mentioned, that even just the fundamentals, the clearance rates, the days on the market, the discounting and those things that indicate that the market's changing to us, and then jumping in and overlaying the income that really is, I guess, the driver to where we see the growth potential. And the fact that you've got 6 people out there looking every day and sharing your advice with them, and they're finding the properties for your clients, and we're kind of piggybacking on that. So it's really great to see that 2016 has still buying potential for us all.
Yeah, it does, and obviously it will be a challenging market, but with the right research and determination and using your guides and also using this information, it's going to give you the best opportunities for success.
Great. Thanks a lot, Ben. Now, my next guest is Jacob Field, the creator of the tool Ripe House, which applies research and analysis tools for DIY investors to discover if properties within chosen areas are going to be good investments or not. Hello, Jacob.
Hi, Jane. How are you?
I'm great. And yourself?
Really well, thank you.
Gosh, it's an exciting start of 2016, isn't it?
I can't believe we're already in February.
I know,
I'm still bracing myself.
Well, it brings me to the question, 2015, February last year. What was on the table then, and what have we seen in the last year?
Well, casting my mind back, a lot of focus and a lot of movement has come through Ripe House in the last 12 months towards Brisbane. Mm-hmm. That's still obviously occurring in great numbers. I think December, 45% of all suburb inquiries were for the Brisbane area across the whole country.
Interesting.
the subtleties around the wares in Brisbane has changed. Early 2015, it was around the Logans, around the northern quadrants, up towards Chermside, anywhere between Chermside really and down towards Ascot in the northern side of Brisbane, and definitely Logan. A lot of eyeballs on Logan. That's sort of now dissipated. And we did have some good results in Logan. I pulled some numbers. Kingston was probably the #1 suburb through Ripehouse for investors who purchased in 2015.
So people were making money there. We got that right, hey?
Yeah, 9.4% growth in Kingston for 2015.
Which would have to be one of the highest in Brisbane, wouldn't it?
Yeah, it's not up to the level of a lot of Sydney suburbs, but if in terms of Brisbane and focusing towards a 3 to 5 year outlook, and this year is #1, it's a great result. I guess we did see around June, July, a lot of the ability to discount in the market became far more difficult to achieve. Any discounting really at all, investors fighting over each other. That transition definitely did occur in mid last year, and the market really pushed back towards the vendor with the power.
Great. Well, I guess that kind of brings us to 2016, and I know that you have been frantically working on some new resources for Ripehouse. And I'm just going to share the screen now with something that I think is going to be live this week or maybe next week. Is that right?
Yeah, this week. So first week in February. We've tried to really open the hood up of Ripehouse and I suppose empower the investors with the data that we see, and we form our decisions and guide some recommendations. So the starting point that we've got here is the state of the states.
And this is really exciting. For those who don't know, would you like to just give a quick explanation of what the property clock is here over on the left-hand side, and where we see the states as a whole at the moment, and we'll start nailing some of the capital cities and areas of influence we want to concentrate on a little bit later.
Yeah, beautiful. So whenever you see the little heartbeat icon next to a text element, that means the data is live. So whenever you see a property clock or any sort of growth or volume information in the general media, it might have a lag time of up to 3 months. This data is literally live. We've got a finger on the pulse in terms of our research platform to today, and this data sort of rolls. So you might refresh it tomorrow, and a state will literally move into the next zone on the property clock. I suppose this page is a nice news story, and it does get picked up in terms of New South Wales moving into the past the market peak, etc., or Sydney moving past the market peak might be the story now. But then it's a little bit deceptive, because New South Wales, as a state level, is an aggregate of capital city and regional areas. So the story, digging a little bit deeper, which we can do in a moment, is that Sydney is firmly in the 12 o'clock and into the slowdown phase in the 1, 2, 3 o'clock, but it's the regional areas which are outstanding at the moment and still dragging New South Wales back as a state to the growth phase. So
essentially, what I'm doing here, when you're talking about 12, 3, 6, 9 o'clock, if I assume this is a big clock, I've got the 12 o'clock here, 3 o'clock, 6 o'clock, 9 o'clock, and the 12 to the 3 is a slowdown that we would see in the market, and 3 to 6 is where it's kind of getting to that trough and the bottom point, recovery, and then growth. So what you're saying is Sydney is up here in the 12 o'clock and just pushing past, so it's in the start of the slowdown, which doesn't mean going backwards necessarily, it just means slowing down. But New South Wales is sitting over here because it is an aggregate of the regionals, and we're seeing some huge interest and growth in some of those larger regional towns. Is that how I read this?
Yeah, absolutely. And that's the deeper dive. And that's, we can probably talk on this for a while, but when things are in the trough phase and the slowdown, it's more of a confused market, so there's conflicting signals. That's probably, ACT might bounce back and forth for a few years before it works out which direction it wants to go in, and then, when it actually comes into the recovery, there's an alignment in those signals, and then we're sort of more sure of the pending growth. So in terms of a nice, time moving smoothly forwards, it doesn't usually happen that way. So it's great to see the data live and seeing how suburbs might be states might be a little bit confused, or very strong, nice So Tasmania is a beautiful pattern of forward movement through the recovery phase. Going back to 12 months ago, it was sitting at about 7 o'clock on the property clock, and it's moved through to 9 o'clock in the last 12 months, and very consistent story in terms of the different metrics that we look at to gauge where it is on the clock.
And this key property data, it's a nice little overview, and as you say, it is an aggregate of the states, but it gives us an idea. New South Wales is the driver of the property clock. We often see it starting first and Melbourne coming along and Brisbane behind it. But, it's got 1,000 more suburbs in it than Victoria. And I guess, these all collate up to the 14,000 or so suburbs throughout Australia. So we should probably dive deep on one of these. And you've said the interest is where in Queensland. So how about we jump in and have a look at what's coming up in Queensland and this next tool. Now, I guess if we were trying for 2016 to determine where we should be headed, we should be probably looking here at the property clock and maybe start classifying some suburbs we need to look at, so we're not looking at them all. So on the property clock here, what would you suggest that we chose between? Maybe that trough?
I like to look around 8 o'clock, so we're a little bit surer of things having progressed through the trough and through 6 o'clock. And 8 o'clock's a nice demonstration of at least a recovery that has started.
A bit of proof that something's happened.
Yeah, and then 10 o'clock is sort of getting towards the last point I'll potentially be looking at to buy. You've definitely got some scope for growth in the short term, but you still want to have that growth. So the further you get towards 12, the less likely further growth is likely to occur. Outside of, all we're talking now is outside of the macro economy, outside of national growth.
If you were going to put one more criteria there, Jacob, would you choose what days on market, maybe maximum days on market, to refine this a little bit further?
Yeah, let's, Queensland's a big place. We've got a lot of rurals, regionals with high days on market. If we set 150 days on market, it's a nice... it's a nice health check. It means that we can potentially sell into the market if we needed to. Obviously, that can change in the future, but it's a nice buffer. The other interesting thing, so because we've taken a deeper dive now into the local government area level of a state, we can have a little bit of a health check around what's going on there, and this looks at some of the metrics that go into the property clock, but it takes a bit of a deeper dive into them, and that's the ticks and crosses there that you can see.
So if we were going to look at, I guess, one area here that is coming up in these council areas, I mean, there's a lot of things that we've seen at the moment. It seems here that we've got a pretty good opinion here around Moreton Bay. So we jump in here a little bit further and have a look what's happening in that area?
Yeah, potentially we can even just filter this really quickly. And so with the health ticks, if we say have a minimum of 3 requirement, it's going to remove the basket cases, I suppose, where the numbers or the property clock might be great, but there's a bit of a conflicting story in terms of our health check. A few of them just visually there. If you filter that to a minimum of 3, it might take out. So obviously, the more ticks there, the better. But we can't have everything, and so if starting off at 3, we can take a deeper dive. This is really now bringing us towards the peak of the Queensland market and some really standout LGAs. City of Brisbane, which is quite a large LGA, City of Gold Coast, Moreton Bay, a couple of regionals which we might have a look at, or Sunshine Coast, which is really standing out.
Now, you mentioned to me the other day this opinion score here. This was of interest. You're daily going through the media and seeing and talking to experts and real estate agents, and you're using this to kind of create an opinion score of what's happening in the market and what people are talking about. That's an interesting, I guess, criteria I haven't seen applied to other kind of research tools.
Yeah, I think it helps us zoom in a little bit into maybe ordering. Obviously, experts sometimes get it wrong, and some experts might make or have an opinion that's not formed on data. It might be more of a hunch. So when you're sort of starting to aggregate opinion and judge the sentiment upon it, we can compare apples with apples. And
perfect. Well, let's just jump straight in and have a look at Moreton Bay, and this is one of the tools that is live this week, which is pretty exciting. And just while this is coming up, do you want to explain to me what we've got here in the big green, which looks like we're seeing here in Moreton Bay at the top, but big green, boomerang, cash cow, and undercover. What am I looking at there?
Yeah, sure. So Moreton Bay, we've come to from all of our research, the #1 LGA in the country at the moment in terms of on-the-ground metrics, investability. So if we start with each individual element on the radar chart there, metrics is a health check, a suburb level health check. It looks at those 6 ticks or crosses. Sales volume, has it been trending up in a nice steady fashion? Is it at a high point in the cycle, which demonstrates that it's in that recovery and growth phase of the property clock? Yield health, is yield at a nice high point in the cycle, meaning that there may be some underpricing or value that can be extracted. Yield trend, has that been trending upwards? So has it been a nice healthy movement upwards? Days on market, is it trending downwards, and is it at a low point in the cycle? These are a really nice snapshot of the health of a suburb. When the numbers are alignment and there's more ticks, that metric score will be a little bit higher. Interest. So we've got a finger on the pulse in terms of a lot of investors using Ripehouse these days, and we're looking for movement and trends with you guys. Which areas you're moving towards. Moreton Bay was one of our top LGAs across the whole country, has been for the last 3 months, so the interest score is very high there.
It's important, sorry to interrupt, that interest, because I guess from my mortgage broking company and from your research company, we're usually seeing where people are looking 3 months ahead of before they buy, because they're getting their research done, their pre-approvals done, and then they purchase, and then 6 weeks later, if they purchase in that time frame, the sales come up, and then usually a month or so after that, the media says, hey, we've got a hotspot. So what I like about this, and people may not realise, is that interest there is actually showing what people in Ripehouse are researching on at the moment, and it really is a bit of a lead indicator, a secret kind of indicator that a lot of people don't have access to. So I really like that interest score. That's the first time I've seen that added too. And so you're moving on to investability. What's that?
Yeah, investability. So a big part of Ripehouse is making sure we invest on the right streets within a suburb. We've defined a combination of 5 things at a street level, which our tools help you find really quickly. That's a Ripehouse sweet spot. That's demonstrated to achieve over 21.9% relative growth above and beyond the rest of the suburb. This is telling you, are there properties that are in demand currently for sale in those key streets, and that will then have a higher investability score. So you are able to access that market and buy there.
So these are things like low public housing, increasing rent, increasing yield, increasing rental demand, and a prevalence for the typical type of property that the typical type of person is trying to find, like the 3-bedroom house rather than the 1-bedroom studio unit.
Yeah, absolutely. Perfect. When those things are in alignment, it will qualify as a Ripehouse sweet spot, and then you can the investability score will show you if you can actually buy properties in those streets.
And then we have income.
Income is. Yeah, that's probably a little bit deceptive. Income in this sense means yield. Mm-hmm. We don't just order suburbs in terms of yield, because you get a lot of basket case. When I say basket case rental markets, I'm always have a bit of a chuckle when I'm actually based in Tasmania, when they do the top yielding suburbs across the country, and you see that in the media, etc. Always, or was in the past, up towards the top is Zeehan in Western Tasmania, which the only employer shut down. There's no employment there, and the average median price is about $15,000 for a house.
I was going to say, they were giving houses away there at one stage, weren't they? About 10 years ago, I remember seeing that.
Yeah, so your yields are going to be great if you can actually get it rented, but I know that there was like 3 years vacancies and things like that going around. So
the numbers
we do
still
have a bit of a income for that score to be high. It needs to have a high yield, but it also needs to have a minimum level of health. So reasonable rental volumes and low vacancies to qualify.
So if we move on to I guess to the next state, but I don't want to leave this now. If we were going to pick one place in Queensland, Moreton Bay, you would say the big green, which is kind of means that it's touching all of the components there, is Caboolture South.
Caboolture South, right up there at the top. For similar sort of Belmare's at a little bit of a different price point, so that's where you're syncing it back to yourself and what you're trying to do. Mm-hmm. Caboolture South and Morayfield are very, very similar. They actually border each other. Caboolture South is a mini Morayfield, as separated out from Caboolture itself, just north. You may want to actually get in a little bit earlier than that, before the interest has started to become a bit of a groundswell on that when a boomerang That's more aligned to a boomerang strategy.
Well, let's see if we can find a boomerang in where shall we look? Maybe New South Wales next?
That sounds great.
If we head to New South Wales and we apply these same property clock criteria between 8 and 10, because we want to see some proof of improvement, we take out some of the regional areas. So if we pull up here some of these stats, and 3 ticks shall we go with again, making sure we've got most of these things covered. So we've got some really good council areas that have come up here, some interest.
What I have noticed, and this is a really stark finding in the last couple of weeks, if we didn't put the filter of property clock on there, a lot of the middle market or upper market of Sydney is 2 or 3 o'clock on the property clock. So it's really, sales volumes have dropped through the floor. Days on market are starting to come up again, and yields at a real low point in the cycle. It's the western areas, typically lower price points in comparison to Sydney, that are really standing out and holding back. So we've got some of the LGAs through Ashfield, Bankstown, Blacktown, Camden, Campbelltown, Canterbury, Fairfield. They're still firmly at 9 and 10 o'clock. Looking like they've still got some growth left in them. So when we speak at even a city level with Sydney and the population there, we're still talking too broad, because there's hidden storylines within all of these LGAs. And exceptions to the rule.
Which is interesting. I mean, we had some data that came out to say, just last week that for the quarter up until the end of December, there'd been a drop in growth in Sydney by 2.3%, and today, or this week, the information's come out to say, it's regained 0.5%, and it's such a small increments in a small time frame, but as you say, there's pockets of potential. We know that within suburbs when we're looking at houses and your sweet spots, for instance. But as you said, in Sydney, there's still a lot of legs to the market, and I think that what you're indicating here, and some of the other people I've been talking to have indicated that there's still some suburbs and areas that are going to keep pushing Sydney and have maybe 6 to 8 months worth of growth still in this cycle before they lead again in the next cycle.
Absolutely, yeah, and it just makes logical sense, really. If people have been priced out into their aspirational suburbs, or the suburbs they're looking towards, then there potentially is a mass movement as a secondary growth cycle in the lower price points, which we're sort of seeing there, and that sort of suits that dialogue. Yeah, definitely. To the next degree after that, the demand, and particularly probably investor demand, has been pushed that one ripple outwards into the key regionals. It's virtually everywhere else in New South Wales apart from Sydney is right at the growth and the recovery, the really strong growth part of the cycle, all the way right up to Tweed, which joins into the Gold Coast.
Interesting.
All of the key centres. Tweed's a great one for all the same growth drivers of the Gold Coast. Tweed is represented there.
So I've just sorted here by opinion, what people are talking about, and I guess your conversations with real estate agents, etc. And, I know previously we've looked at Wollongong and Albury, but if we click through here to Newcastle, because I know when we talk about the ripple effect, it can run to those next areas like the Wollongongs, the Newcastles, the Gosfords, etc. Maybe we could dive down here and find one of those boomerang suburbs that you mentioned that haven't really got on the radar of interest yet, but have the metrics to indicate that they should be well and truly placed there. So what have we come up with here?
Let's do it, yeah. This is so what we've done. We've directed into this is every suburb in the Newcastle LGA. Just a bit of an asterisk. Most LGAs don't look like this. So when a suburb is more of a no-go zone, if you scroll right down there, Jane, you'll see a lot of red areas. So you can really get the contrast. If you go right down to the bottom, you can see a lot of contrast, because most suburbs in Australia look more like these redder areas, which have no real alignment in any way. So what we've done now is we've really come to the absolute tip of the iceberg in terms of investor potential, and we've looked at a state into LGA, into suburb level, and Merewether competes at a national level. So we're talking boomerang is the shape, which loosely is the shape of the Merewether suburb there. whether if you use your imagination.
Squint a little bit.
Interest hasn't caught on yet.
Yeah. So what we're saying here is that the interest, people aren't looking there, but the metrics are stacking up. The people are there's articles and publications and real estate agents and buyers agents I've been speaking to have said that this is somewhere they're looking, and it's got the sweet spots in it. So it could really be somewhere that we target.
And there's actually properties on the market for sale there in those sweet spots, which is, it's one thing to have the perfect suburb, but you've got to be able to digest and buy there with ease and be confident in those decisions. So that's a nice metric there to sum up.
So we're happy to say for New South Wales, your pick is this area for 2016. We're going to have to watch out for.
Let's do it.
All right, well, how about we try to find one of your undercover suburbs? And there's been a bit of interest, I know, of late, early 2016 in South Australia. So do you want to take us through some of the metrics there and what we're seeing in South Australia?
Sure. So opinion scores are typically quite low through South Australia. There is some alignment in a few of the key suburbs through or closer to the CBD. In terms of sentiment the opinion score. So that's sort of probably something to put in context and to remember. But looking outside of, we're really thinking about an undercover suburb now. So we describe that as somewhere that the opinion hasn't really caught on in a groundswell of movement. There are a couple of suburbs there in West Torrens and Okaparinga that are actually already boomerangs, potentially almost going to be big greens. But undercover, we're really trying to be that first mover. We're trying to look at absolutely outstanding number plays where the opinion and interest hasn't caught on yet. So
Jacob, if I click here on undercover, in theory, these are going to be suburbs that are going to pop up that aren't really on anyone's radar at the moment, but there's some sweet spots. We've got some good dynamics around the metrics, and there's some income. So I see that South Australia is well and truly leading the field here on a couple of those undercover areas.
Yeah, Hectorville here, absolutely outstanding metrics. You can't get any better in terms of 6 out of 6. Investability is great, income's great, really hasn't caught on in terms of sentiment and interest. And then the top 3, when we order these, so this is a national, so when you talk with the strategy toggles there on the left, the strategy badges, that's then assessing the whole country at once, and it's bringing all of those undercover suburbs together, which are typically the same shape. It's picking and choosing across all LGAs and bringing them in one place. So South Australia is competing at a national level with these suburbs in terms of the sheer numbers. A few interesting ones like Collingwood, Caroline Springs, still standing out in Victoria and Melbourne. DY, a suburb there in Sydney, and areas like Majura have great numbers at the moment.
So it's good to see that I guess, for those that are happy to invest and take a little bit of a risk and not follow the market somewhat. I imagine if we put in that 8 to 10 o'clock on the property clock, some of these suburbs wouldn't come up because they haven't started the recovery. It's kind of like really anticipating and not having any proof of movement yet before the market moves, getting in at that point. So these, I guess, from a point of view of 2016, some secret areas that you could start looking at are these areas in South Australia.
Yeah, yep. Absolutely.
Well, let's not leave Victoria behind, and we'll jump up into Victoria and have a look. And we might actually go in deep here and choose an area and do a little bit extra analysis. So if we choose once again 8 to 10, we start to find some of that market and maybe 3 on the health check ticks. Make sure we've got a few areas. So quite a few areas come up here, and I'm just going to classify by opinion, and let's go to the top one. How about we choose Geelong? Geelong's
a great one, and we've had obviously great growth at a city level in Sydney and Melbourne. Wollongong, Newcastle, and Geelong are satellites, or the key satellites of those two majors, are all in alignment and really, really standing out. So we've picked that suburb in Newcastle. Geelong is an outstanding place to cast our eye across at the moment. spoken with a lot of on-the-ground experts and worked through some suburbs, etc. What's going on there, and it's Brad here in the office doing his research this week on Geelong. He's just been blown away by the level of infrastructure spend, public and private, in the Geelong area. Yeah, this would probably be my big hang my hat on as a Ripe House identified area, I suppose, for 2016, which hasn't sort of been probably spoken of widely.
Oh, well, that's a big call there. So why don't we dive in deep? Okay. So
this is, I suppose, introducing to the street level analysis within Ripe House, which helps us try and find out and get our finger on the pulse as a local potentially would in the suburbs.
So what we're seeing here, I guess, is we've got this this area here, which is the Hemlyn Heights area. We seem to have a lot of green grass and not many houses to the left, a bit of a quarry by the looks of it. And we've got these other surrounding suburbs. Now, these suburbs here are more mainstream suburbs, so we're really kind of looking here at this area. How about we dive in? I'll have a little bit here. It says there's 45 properties on the market. 3-bedroom houses are the most common. Let's have a look at maybe the occupancy type. So one of the things that we talk about as an investment opportunity is we try to see, that renters want to rent there, don't we? So this occupancy type gives us an indication where the yellows are as where there's a higher degree of renters. Is that right?
Yeah. This is actually a really nice pattern because it's a real contrast there with owner-occupiers in the darker green. The darker the green, the more owner-occupiers in that street, really concentrated towards that highway access, potentially commuting to Melbourne, while tenants are concentrated on the city side of the suburb and they might be walking into the CBD for work, etc. That's a massive generalisation, and I'm just trying to work out the reasons, but that's a very stark contrast.
And it's good to, I've got a tutorial on how to go through census and pull this information, so it's really great to see it with the click of the button. So we've got 21% rented there, and the local government area is 25%, and the state's 26%. As investment grade, we usually try to look at around 30% rental, but if we click on these areas here, that's where the tenants are, we can see the rental density is up around that 30%. So these potentially would be those areas that we would concentrate on. I guess the other thing is looking at property type. So there's only 11% units in the area, and we know that, what have they said, there's 3-bedroom houses are the most common. So we probably see that around where those owner occupiers are, but this is probably where a lot more of the units are. So there's a higher rental density, which kind of makes a bit of sense where those tenants are as well, doesn't it?
Yeah, it's about finding that balance. We want to really be sticking to the 3-bedder houses, but we want that minimum 30% tenant demand. So trying to find the combination of the two. This is probably a little bit deceptive because anything that's highlighted in yellow is under the average unit density, and the average is only 11.3. So we're really not dealing with many units at all in the suburb.
Well, how about we just jump in as a final kind of criteria and have a look at the special Ripe House strategy. So here, there's 15 areas. Now, each one of those areas is the smallest kind of census areas, and about 200 properties?
200 dwellings, yeah, roughly.
So we want to go for, what shall we choose here, the capital gain strategy?
If we click on the capital gains, yeah, that's going to be the Ripe House sweet spot area. So under 15% public housing in that street area, as we mentioned above, 30% tenants. It does cap out at a maximum level of tenants. It's not an issue here. Rent per week, we want above average rent. So this is a really interesting combination. If we're looking at short to medium term growth, it's usually on the back of investor interest to start with. Yields are at a high point in the cycle, etc. So we want to find the streets where investors are potentially really the renters are really focusing and demanding. So looking for streets that have above average rent and above average yield is a really nice combo. When you can find them together, it's really powerful. In this case, when we apply that filter by default, we've only got one area that passes all of those tests. That will be displayed here on the map. So it's obviously a very small area in Hemlyn Heights. You might like to join up a few suburbs. So we did see, I think, Belmont in Geelong was worth looking at as well, potentially joining up the sweet spot areas from a couple of suburbs and really just focusing your search in on those key streets. might be a good way to go.
And if we just looked at very quickly here properties on the market and maybe even filter the properties by our strategy.
Yeah,
and
that sounds great.
We've said we would want a 3-bedroom typical property and a house. So we could very quickly here see if there's 3-bedroom houses in the sweet spot.
This, there may not be. There's 45 properties on the market. Actually, there's 2. So these are the 2 that I'll be looking at first. Sometimes in this case, it's actually described as one, so it might have a house on the back. Agents describe it as a house, but it's a dual occupancy type arrangement. So that may, sometimes the agent might be a little bit optimistic with the descriptions. The other one on the market, H-Town Avenue, is right in the sweet spot. It's the in-demand property type. It does look like it's had a reno, which might suit what you're trying to do or not. This suburb, really, it is home, and a lot of the neighbouring suburbs are home to a lot of Federation and older style properties, so it might work really well for buying that unrenovated property and applying the Trident strategy potentially, Jane, and renovating through to the upper extent of prices in the suburb. It might be really suited to Hamlin Heights.
Fabulous. Well, I guess what we've been able to do today is very quickly get from that national level and having a look around. Now, just not to leave out the rest of Australia, because I know there's people from everywhere. I'm just going to pull up while we're talking some of those other areas that have come up in Western Australia and maybe in Northern Territory and as well. But
there's actually a few in Western Australia, not so in Northern Territory, a few reasonable LGAs in Western Australia. So I think Claremont's a real standout for me. It's at the higher price point. Belmont, a real standout as well. So
there's some areas to watch for. It's not all doom and gloom. There's pockets of potential.
Absolutely. I think at any one time there's always probably 10% of really nice potential, and it's just about finding them, and it's also about finding them with data that's live or as close to live as possible, and not relying on second or third hand or 3-month delayed data. It's potentially acting on it as it's happening. I think is really powerful.
So we've got some areas here that have come up. So not a lot of opinion or interest. So would we put these in the maybe undercover?
Probably not. It probably hasn't progressed that far yet. So this is more of a representation of WA, maybe as a state at a different part of the cycle, and that's filtered all the way down to this suburb level, where even the higher ranking suburbs in the state are still not demonstrating really accessible markets or suburbs. So this is number one in this LGA is, I won't even try and pronounce it, it's still not really getting close to a green. Okay. It might be one to watch.
Watch and see. And I'll just quickly jump to Northern Territory and once again to one of your favourites, I guess. Well, let's have a look at City of Darwin, but we can't leave Tassie out, can we?
No, Tassie's got a really compelling story. I always talking to investors around, so what about Tassie? And they're always put off by the high days on market number. Some standout suburbs there in Northern Territory. Investors are generally put off by the high days on market number in Tassie. Tassie's population is spread across the state, and a lot of it's spread off into regional areas. So Hobart, City of Hobart's got really low days on market at the moment. It's in absolute prime part of the cycle. You've got some, on a national level, you've got some outstanding growth markets coming into 2016. I've actually got my principal place of residence in West Hobart. It's a great spot. I walk into the office. It's about 10 minutes walk. Great fundamentals on a national level. It's actually in a big green state at the moment. So if you did the national big green search, you would come up with West Hobart. Days on market is just right through the floor at the moment. It's very difficult to buy. The emerging markets are definitely Moona, West Moona, and Newtown are real standouts here on the ground, and that's represented by the colouring and where things are sitting. So definitely don't consider, that's one to fall in the trap. You would write Tasmania off completely because of the high days on market number when there's so many subtleties at a local government area level that would go unnoticed.
We, I guess, have a final kind of review of what we've been talking about. So we've seen I guess, what's been happening throughout the states. 2015, the thing I love about the Ripe House software is that we kind of have that undercover. We're using all the metrics. You guys are out there doing the analysis of you've got Brad doing the infrastructure of Geelong this week, and you're talking to the buyer's agents, the real estate agents. So we're getting kind of a bit of opinion on what's happening on the ground, but we can also use the metrics to anticipate that ripple effect, the undercover suburbs. And it really shows us that although the states are moving through that market that we're seeing, that property clock, there are markets within markets, which I think a lot of people forget. And when you're reading the media, it's easy to say, right, wipe out Sydney, for instance, or don't look at Melbourne anymore. But there's still some opportunities out there. And
yeah, no, that's exactly right. There's always pockets of gold, I suppose.
Well, I really appreciate you joining us this evening, and looking at 2015 and then forward into 2016. I think everyone's got a few little hotspots that they can start going and doing some analysis on, which is fabulous. And I'd just like to mention to everyone on the webinar that if you go to the link that you can see now, Jacob has very kindly offered those people new to Ripe House a 14-day free trial. So you can get in there and interrogate some of these suburbs that you've seen this evening. So I really appreciate you offering that, Jacob. Thank you very much.
No worries, Jane, and thank you very much for having me.
All the best. So I really hope you've made some notes. So if you have any questions about what we've covered or anything else, I'm going to be opening up the lines now. So when you have a question, all you need to do is raise your hand by pressing the little hand icon in the sidebar menu. It's quite small and hard to see. Now that little hand button can actually look a little bit like this. It depends if you're on a PC or a Mac. So clicking the hand button will notify me that you have a question, and when it's your turn, I will unmute your line and we can have a chat. When I do unmute your line to take a question, you'll get an automated message saying your line has been unmuted, and then you know you are on. Now, you only need to use the hand button if you'd like to chat. Otherwise, you can also ask questions by writing your question in the question box at the bottom of the control panel. I do give priority to the spoken questions, and I can give you a much better detailed answer if we can talk about it. We do have a lot of people on this call. It's amazing how many people here. I can see so many comments already. So if you do have a burning question, put up your hand and let's chat. And of course, remember, as I said, there is no such thing as a silly question. So I really encourage you to raise your hand and have a chat with me. So let's open these lines and have a look who's here and what questions that we have. So who do we have here? I see Aidan. Aidan, I'm just going to see if we can unmute your line now. Hi, Aidan. Hello, Aidan. Have you got a microphone? Oh, Aidan, we might have to move on to another person. You might put your question in the chat box and I'll come back to you soon. I'm going to go to Chris. Hey, Chris, I hear you. Hey, Chris. Oh, we're losing your sound too. Donna. Oh, we're having some trouble getting people with microphones. I'm going to get you guys to just post some questions into the chat box while we go ahead. So I've got a question here from Lily. And Lily says she's got a small home of 14 squares that's been fully renovated from the previous owner, and she already owns 3 properties. She's struggling to decide what she should do with her home. Should she subdivide it into 2 or rent it out and buy another one to live in? So each has its pros and cons. Is there any way you can help me make the right decision? Well, Lily, thank you so much for your question. And I guess we're getting a little bit specific here on actual properties and questions rather than location, but it does actually come back to location. And that question is, should you actually convert your home into an investment property? And really what we've learnt tonight from Jacob and from Ben is that it really comes down to that investment grade area that is going to go up in value and create wealth for you in the long term. So my answer to you would be many people convert their homes into an investment property and move somewhere else, especially if you're feeling that pressure that you've got at the moment through size. But the reality is your area that you actually have your home in may not be investment grade. So you need to know the area specifically and go through those details that we kind of ran through tonight. You know, we're looking at vacancies, median prices, a typical property for the area. If you're already feeling, I guess, some of the size pressure, then maybe it's not the typical property for the area. What does the majority or the target market really want? So I wouldn't be necessarily keeping the property as an investment if you decide to upgrade and move elsewhere. Should you subdivide? I think the thing about subdivision is that, once again, I'm not an expert in subdivision, and you need to speak to your local council about the requirements that they have, because each council has different requirements and specifications. But it does come down to the size and what the two final block sizes are. So if the typical size block in the area is 600 square metres and you're starting with 800 square metres and you're ending up with two lots of 400 square metres, then you're actually smaller than the typical size block as well. So you may not get the return that you think you necessarily might get. So there are just a couple of your points that could help out. Okay, let's unmute the line for Troy. Hello, Troy. Are you there? Yes, Troy, I can hear you. Hello, Troy. I hear you breathing. Hey, Troy.
Hey, Jane.
Hey, how are you going?
Good, how are you? I don't know what I did then.
Did you want to put your hand up?
Yeah, sure, now that I've got you.
Okay.
We've just purchased a property down on the beach, on the peninsula in Adelaide.
Nice.
With a big block size. Do you have any news on sort of the western suburbs, beachside suburbs of Adelaide?
Ooh, I don't specifically have any information. So did you buy this as a home or an investment?
As a home, we're looking to invest once we get some equity here.
And what were the drivers that you used to actually target that area? Did you kind of put your investment goggles on when you were looking at the area?
Yeah, we did. There was a bit of a trend that's come from like the beach is more south to where we are, and it's kind of been pushed up towards where we are now. So I was kind of hoping, but hadn't done that much research.
So what's the name of your suburb?
So I'm in Taparoo, which is, Largs Bay.
Taparoo. You know what? I do have access to Jacob's wonderful software here. I'm going to see if I can actually pull this up and have a look. So have a look at it for us. But so I guess the thing is that when you, even as buying as a home, and I think that a lot of people, when they buy their first property, they, it's not necessarily the property that you're going to go back to in 30 years, 40 years time and have grandkids coming and visit you at. So it's important to be, I guess, realistic about the time frames when you're buying a property, and the fact that you've kind of considered it as an investment is a good thing. So if we, I'm just going to try to pull up this this suburb now. So
No problem.
And just see if I've got anything here that we can just quickly have a look at some of the indicators for the area. So the thing about the areas, South Australia, as you heard from Ben and also from Jacob, it's almost like it's on the watch list now, and people are getting there, and we see that cycle of the markets when we move from the Sydney, the Melbourne, the Brisbane, and then the other states come along. So it's interesting that we're actually going to see more, I think, emphasis this year in the South Australian market. And I'm just going to see if I can add this to my suburbs and pull it up. Sometimes internet doesn't always work for me. Let me just do this.
I could see it there a second ago on the screen.
Here we go.
If you scroll,
I'm glad I've got you directing me here. This is good. Okay, so what I'm reading here is that, look, there's 19 properties for sale at the moment. The most in-demand property is a 3-bedroom house. And that, what have you got?
We bought a 3-bedroom home.
Well done. And I'm just going to scroll
Yep.
out just a little bit. So I can see it's right there on the peninsula. And I'm just going to
Yep.
apply a couple of criteria to it. So I might just have a look from a point of view of yield. So you can see that this suburb here is it Osborne? It's
Yep.
darker red. So it's actually got a better return. So it's got a return of, when we're looking at the actual yield, of 7%. Compared to a return down here of 4.5%. So it's interesting to see, you know, if I was going to say that there was areas here that had some opportunities for, you know, price kind of pressure, one of the indicators that I look at is that yield, because it's what investors are trying to always determine of, you know, where they're going to get their money. So that's one thing that I'd look at. Another thing that I might look at is the vacancy rate. So, you know, you get a feeling for what's happening with vacancies. So, you know, here we can see here the vacancy toggle. The darker the red, the overlay, the higher the vacancy. So, you know, this area here would be of concern to me because there's more vacancies indicated here, the darker red, whereas in these areas here, we're seeing a lower, you know, 0.87, which might be characteristic. You know, we heard Ben talk earlier about the fact that South Australia, some of those suburbs are, you know, 1 kilometre square. And I did a quick analysis for someone the other day, and some of the information he was saying is that, you know, we're looking at the census information where owner-occupiers live compared to investors, and there was only 2 actual areas, so there was only about 500 people dwellings in the area. So it's really hard when you get to those smaller areas. So, you know, some of those flow-on effects are actually characteristic of the whole, for instance, peninsula. So, but what we're seeing here is, you know, there seems to be some really good opportunities for returns in the sense of vacancy, in terms of yield, and that's usually one of the things that drive some investment demands. I guess the other thing is just being aware of transportation and infrastructure, and you know this area a lot better than we know the area, but you know, if I'm looking at one of those areas, I'm looking at access, you know, to these major roadway arteries, I'm looking at access to the shopping areas and schools, etc., because those kind of things actually, you know, do drive the area. And you know, we've got, as we can see here, we come in, you know, it seems to be buses rather than trains, which makes sense when we look here that it's across the water. But, you know, there's a lot of transport available. There's a couple of schools in the area. And, you know, this is linked as a cash flow area. So that kind of yield characteristic is what we're seeing. And often we see that investors follow the yield. So I think we'll see that more and more in 2016 when we get the people who are refugees from the share market, is that a good word? Refugees from the share market, and they're disillusioned with their superannuation, and so I think that, you know, just looking at that, it sounds to me like it's got a lifestyle element to it, and I'd just be a little bit concerned about, you know, where people work, and if you're too far away from, you know, if the hub is the Adelaide hub, just being aware of the transport characteristics of how people can get to work. But having just enjoyed last Easter in Adelaide, I have to say I did enjoy that area, and there's some beautiful homes down there. So yeah, I definitely wish you all the best, and hopefully that it grows in equity for you.
Beautiful. Thanks, Jane.
All the best. Thanks, Troy. Okay, we're just going to choose another person here. And I've got Rowan. Rowan, you've got your hand up. I'm just going to unmute you. Hey, Rowan.
No, I don't.
Hi, Rowan, I got you. I can hear you. Oh, he's put his hand down. I think a few people might have been chatting, putting in questions. Okay, we'll see who else has got their hand up. Leave your hand up if you want me to open microphone. Lindy, this is you. Hey, Lindy. Nope, no microphone. I've got hundreds of questions written here, so I'm just going to give another person an opportunity. Is that Donna? Shall we give Donna Donna, I can see your microphone's on. Can you hear me? Okay. Well, one more before I go to this large list of questions that I have. Amelia. Let's give Amelia a hello. Hey, Amelia. I can hear you. Hi, Amelia. Oh, everyone's getting nervous and putting their hands down. Well, look, I've got another question here, and this is a bit of a different type of question because Maggie's got a question here from New Zealand, and having my better half is from New Zealand, so I've spent a bit of time over there, and we've got a property there actually. And Maggie says that she lives in I'm terrible at this pronunciation, so I'm sorry to all the Kiwis out there. Hawera, which is near Stratford, which is where she lives. So this is the North Island on the west coast opposite kind of Napier from my memory. And she says, look, I know the area. I've spotted a 3-bedroom house. The average for the area is $150,000, which is refreshing after the numbers that we see in Australia. The rent's $200 a week. We're going to use 100% of our super to buy the property, and I just think that because I know the area, because I live nearby, that it's a good investment. And she goes on to say that she's going to use collateral against that to hopefully buy a home in Australia, maybe Western Australia, and maybe flip this property. So just for those of you who don't know, the information that we have when we talk about location is applicable anywhere, and it's about, I guess, the fundamentals of knowing what the investment is. And the thing that I hear time and time again is people say, I know the area, that's why I'm investing in the area that I live in. And so some of the fundamentals, Maggie, you need to ask yourself is, what are the rental vacancies? You've obviously got a good yield, and potentially that yield is driven by the fact that there's not a lot of properties available, but just clarify that. Work out what the typical property is. If the typical property is the 3-bedroom house, which is typical in most suburbs in Australia, and you indicate this is a 3-bedroom house, then that's great, because that means the majority of people want to rent it and buy it if you have to sell it. Work out what the potential growth is too. Now, growth is driven by demand, it's driven by increased income, as we heard from Ben tonight, and it's also driven by economies, emerging economies, and employers. So just know, what is actually driving that economy. Now, we've seen a lot of places in Australia that had a thriving growth, but they had one economy, say the mining economy. And when that was stopped, we had problems associated with the fact that people couldn't rent or sell those properties. So just be aware of that. So if you're thinking, I know my area, therefore I can invest there, I really urge you to really get to know your area. Know what the median price is, the typical properties, know what the income is, if income's growing up in the area. Know things about the yield, vacancy, days on market, clearance rate. Once you start working out that type of information and really knowing your area, then get in a bit deeper about the infrastructures and the economies that are driving the market. Just a word of warning, Maggie, you said that you might use the collateral, that property is collateral against buying in Australia. It is very difficult about borrowing money in one country or cross-collateralising or using funds from one country buying in the other. So if you're buying 100% in your super, I'm assuming that you don't have a lot of equity in this property, and you'd have to be able to pull equity out of that property to then come and invest over here. Australian banks, although they are represented in New Zealand, have a bit of issue about cross-collateralising across different countries. So just be aware of that. And the flipping opportunity in New Zealand, well, we are all jealous of the fact that you have no capital gains tax or stamp duty, and it makes the flipping numbers a whole lot more economical. So all the best, Maggie. I really hope that you have a lot of success in purchasing in New Zealand, and hopefully we get to welcome you to Western Australia someday. So we're going to go back to our microphones and see if we've got other people with their hands up. Please put your hands up if you've got a microphone and you'd like to say hello. I've got Lorraine here. Hello, Lorraine. I see you typing, Lorraine. I can hear you typing. Hey, hey, Lorraine.
Hey, Jane.
How you going?
Hello, Jane.
Yes, I hear you.
Good. Oh, gosh, so difficult to do this.
You tell me about it.
I didn't really want to come on here and speak.
Oh, okay. Okay, tell me your question. I'll make it painless.
Okay. Okay, well, after listening to the last lady, I'm thinking maybe I should be buying in New Zealand, where there's no capital gains tax and all this type of stuff. I was just going to say, opportunities are coming to us with this, flip strategy, but you find like half a dozen houses, and I was just going to say that it's very frustrating because, the real estate agents will put all this, blurb about, how good and how, it's got potential to do this and that, but there's no disparity to on-sell.
Mm-hmm.
And I'm finding it very hard, or I'm getting a bit frustrated that I can't find what I want.
Mm-hmm.
And I just don't know. I just don't know how to find, I don't know if our price bracket's wrong, or I don't know.
Look,
It's just hard.
I hear your frustration.
I think I'm frustrated. Yeah.
For those of you who don't know, Lorraine's actually part of our Your Property Success monthly call, and we did some group coaching, and we've been following her flipping her journey for a while now. The thing that you mentioned there that some people may not be aware of, and the key to the flipping strategy, which is buy, usually renovate and sell within a short period of time, is disparity. And I know you've been through, our Ultimate Guide to Renovation course, and you've learnt how important that is. And I really have to commend you, because a lot of people buy, see the block or see a TV show on TV, and it looks, the renovations look easy and it looks fine, and then they buy a property, they renovate it because it needs renovation, and then they can't sell it and make a profit from it, and that is so important. So what you've picked up there is the key to making money in renovation. So you're now putting the filter of that pricing disparity, that difference between the renovated and unrenovated price, onto all the properties you're looking. And when you're doing that, you're working in what's the cost of buying it, the cost of holding it, the renovation cost, and then your profit. And it is difficult.
Exactly.
And that's when having the knowledge that you have is so very powerful, because you're only going to consider properties that will make money, and it might mean that you're in the wrong price bracket. I mean, I know that we've talked to many property experts in the past, and John Edwards from Residex has, he believes it's very difficult to flip in a property that's worth less than $650,000. Mind you, he told us that a while ago, so it's probably $700,000 now. But it is difficult. But I've got students and clients who do it in the smaller, the lower price bracket. It's just a lot harder. So don't give up, and don't let your quality control on your assessment of doing those numbers slip, because as you know, with flipping, one of the conversations we had on the private Facebook group was the fact that there is capital gains tax you have to pay as well. So once you take that out, you really have to weigh up, is it worth all the pain and effort for $10,000-$15,000, or even going backwards? So locating the right property is key, but that pricing disparity and having that there so there's a profit for you between the unrenovated and renovated is the key. So keep your chin up, Lorraine.
But Jane, should I start looking away from, like in other states? Like, can I manage it that far away?
Managing,
I'm
managing a renovation remotely can be difficult.
Yeah,
and I did 2 last year from a different state, and I used my my real estate managing agent for one of them, essentially unpaid project manager, to coordinate all the quotes and get things done. And it is possible, but the thing is, I'm a bit of a control freak when it comes to the project management and the planning of the renovation, and I'm not on the tools, and I don't need to be on the tools, because I know there's a better cost benefit and analysis of me doing other things and someone else doing that and doing it quicker and to a better standard. So the thing is, you can buy interstate, and you could do that through your own research. We've seen tonight how we've been able to narrow down to street levels in other states just by using one tool that we've looked at. But the other thing is that, so you can buy interstate, you can use a buyer's agent and engage them to help you buy interstate, but you can renovate interstate. The flipping of it is usually a lot more on hands-on work and project management, and you'd probably have to be prepared, if you're flipping, to be on that site and take time off and go up there and manage that. So
Okay.
Anyhow, I hope that
All
helps,
right.
Lorraine.
That's
We're still here for you.
Thank you. Thanks, Jane.
Okay,
Bye.
all the best, Lorraine.
Bye.
Okay, I've got some questions here. Justin, so how will Brisbane fare over the next 12 to 24 months? We hear things are going to quieten, but still lots of interest, but not seeing encouraging capital growth. Justin, good question. I mean, people have been predicting the capital growth and the booming of Brisbane for, 18 to 24 months previous. And I don't think that anyone necessarily got it wrong. I just think that the Sydney and Melbourne markets have actually lasted longer than what the growth phase that they went through. That is normally dies down, that drives from an affordability and an opportunity point of view people to the Brisbane market. So we heard Ben talk about the Mexicans going to Brisbane and bringing their money, and how in 2003, 2004 there was the Sydney cycle, 2004, 2005 Brisbane took off. Now there are some, I guess, undercurrents of the Brisbane or Queensland economy, because being commodity type of centric, that has had some effect. But there's nowhere within 10 k's of CBD Sydney that you would be able to buy a $550,000 house. And so we still have the affordability pressures. We have I think we're going to see what we're seeing in the share market and superannuation people looking to invest their property in the long-term growth. Brisbane has had quite a growth build, but you heard what Ben said, and even Jacob, there is still some growth opportunities in Brisbane. And it's really I was even reading a report from someone today who was saying they were so angry that people saying Brisbane hasn't performed, because there's some pockets of potential that are doing 9 to 14%, and so it's, once again, Australia is a big market. Queensland's a big market, Brisbane's a big market, and it's about doing that research and knowing the locations and finding them. So I still think there's some room ahead for Brisbane. Okay, Sue. So Sue's question is, I'm not sure if it's relevant for this question, for this topic. Oh, here we go. Who knows where we're going here? I have positively geared properties and I'm a high income and paying too much tax. Considering buying new as opposed to old property so I can add value for tax benefit. Interested in your opinion. Oh, Sue, look, good question. And I think the thing is, you should never buy for tax reasons. You should buy for the property that's going to get you to your goals in the time frame that you want to achieve them. However, it is really frustrating to have a high income and paying too much tax. Now, having positively geared properties, what I would do in your situation is first and foremost assess your current property portfolio. So if your goal is to have a $100,000 passive income in 10 years' time, then have a look to see if those properties are going to get you there. If they're positively geared and they're making you $20 a week, and maybe at the end of the day you've got 3 properties that are making you $15,000 a year, in 10 years' time, if there's no growth associated with them, all they have done is made you money that you've been paying tax on. So you need to make sure that you have that growth. You really, yield helps us hold the properties until we can get to the time to sell them or sell them down, sell all of them or sell them down, so that you can actually recognise that wealth, put it in your bank and make some money off it. So first of all, I warn you against not buying for tax benefit alone. But I've built my entire portfolio based on buying older style properties, second-hand properties, adding value. I think there was a lovely comment that Ben made that said equity harvesting. So, I did that my very first property, $425,000. I only had, a small amount of money, $45,000, $25,000 went to the stamp duty. I borrowed money, did a renovation, and then 9 months later it was worth $700,000. I equity harvested, pulled out the money and went and bought again. So, that kind of build up and that cookie cutter effect, has allowed me to build a portfolio, but a portfolio that's been built on growth. So the property growth of that portfolio goes up. So, all the best. I hope that that helps you. Now, Belinda, I see that you've got a microphone. Your hand is up. Can you hear me?
Yeah.
Yes, I hear you too. How are you?
Really well, thank you. A little bit confused at the moment, hoping you might be able to just shed some light on a little bit of a question I have for you.
Let's hope.
So my husband and I have a property that we purchased in Brisbane during the boom, the 2004, and we've had a really good run out of that property. I think we bought it for about $288,000, and it's now been valued recently at about $450-ish. And but the rent continued to go up with that and was terrific. And we went from $250 a week up to $475 at its peak. And just recently, it's taken a pretty big hit, and we've come back to having it concurrently on the market for rent for $420 a week, and we're still struggling to get tenants. It has only been on the market for 2 or 3 weeks, but I'm just wondering, have we reached our peak with that property? Is it time to move on, realise the gain out of it, and look for something different, or should we just hang in there for a little bit longer?
So tell me this, is it, so I know that there has been increased vacancies and some difficulty in renting in some of the areas in Brisbane. Have you got a suburb that you could...
Yeah, for sure. It's actually in Kedin, and it's really close. It's 1 street back from Gympie Road, which is the main road into the city. We're about 7 k's from the CBD. The new arterial road to the airport has probably been open for a couple of years now, so that airport staff and a direct link to the airport, it's quite quick to get to there.
Yep.
We're not from Brisbane, so we're sort of, we don't know it really that well, but we're, we're just kind of a bit shell-shocked as that rental return has decreased so much, and we're sort of just thinking, oh, wow, is it time to sort of look for something else? Maybe we're in a bad street in a good suburb. That's what my husband fears. We're just not sure.
So tell me, what type, it's 3-bedroom house, did you say?
It is a 3-bedroom high-set home. It has a built-in underneath, where it's been built up, it's been covered in underneath to create 2 sort of rumpus rooms under there. We think it's quite a good little property, but we're just not sure. We're just thinking, why are we struggling with it at the moment? We've never struggled in the past. We've just always, it's rented pretty quickly straight up all the time. We did a cosmetic renovation on it only a few years back, and everybody seemed to like that, and it kept going well, but now it's just stale.
Well, look, I've pulled up the Ripe House software, and I'm looking at the area. I know this area by, I'm going to say affiliation. My sister and her fiance have purchased there, and a good friend of ours, of Your Property Success, Kaz from Everyday Property Podcasts, buyer's agent up there, was looking in this area and surrounding areas, I know, 18 months ago. And that kind of proximity to the city, and as you said, all the infrastructure, proximity to the airport, really has a lot of those drivers, and the infrastructure, the roads, etc. through it. If I've got this area situated here, what we can see here in the occupancy type, in the yellow is where the renters want to live, and in the green is where the owner-occupiers are. So you were saying, in what area would you...
I actually think we might not be in that. You see the Wavell State High School? We're right there.
Okay, so
in
this area?
Right into near that. So, yeah, it appears to be coming up as Wavell Heights for you.
Uh-huh. Well, let's see.
I know it's actually postcoded as Kedin, but...
Okay. Well, I'm just going... So it's somewhere around here. I'm just going to show rentals.
Just...
in the area.
Yes, right on the fringe of that map.
Okay.
Yeah.
So let's just bring this up. We'll have a look again around that occupancy type. So this here indicates, that's kind of where the tenants want to live. So there is, some, if I just click in this area here, we've got, rental density 31%. So, that's a really good indication of what people are after there. 28% here. It's close to the school.
That's the one we're in just there.
Just here?
Yeah.
So here,
yeah, that's right. Yep, just right.
So this rental density here is 23. I'm just looking up here, 23.9%. I guess the thing about this, if we're looking at that local government area, then we've got 35% of the area is rented, and in these kind of rented areas, we look over here, the bright yellow, it's going to be 52% rented, but this area here would indicate that it's not. I would usually say my criteria is above 30% is where I would like to buy to know that we had the rents. Now, one of the things that Jacob looks at when he does his sweet spot analysis is he looks at distance from schools, and it's one of the things that he determines, is important. And you can see here his sweet spots for the area. And I've just come in way too far. So his sweet spots for the area don't include this area here. So one of the things that that he's found through his analysis of the streets that actually drive growth is that it's more than 250 metres away from the school, so you can't hear the school bell ringing and you're not having the parking issues, but you're still within a certain zone that kids can walk to the school. So it might just be that the area that you're in isn't that prime rental area. Having said that, though, when we look at the sweet spots or the pockets of potential within an area, if I was going to go and purchase in this area now, and assuming that I'd had looked at this suburb and said, is this suburb a suburb with the drivers that's going to have demand and future growth, then what I would do is I would possibly target the areas where the renters want to live, but also in these kind of sweet spots that have the demand in them as well. So not necessarily this area. Having said that, you've got a property there now. You've had to drop the price on it, and it might just be being a little bit inventive about what you might need to do. I mean, obviously you've done a renovation, you've added some equity, your property's almost doubled in value. You've held it for a long period of time. I wouldn't be selling out. I think Brisbane still has some legs to it, but I think getting you over your initial hurdle now of renting it out. Look at things that potentially like what the other rental properties in the areas look like and what they're offering. So they might have fences that allow it to have a dog, and you might then consider allowing pets, because not many landlords like having pets in a property.
Actually,
and you could get the rent potentially that you wanted, but you could put a pet bond in place to protect your property as well. So you might just have to be a little bit innovative now to get this rented. But I think that I wouldn't be rushing out and selling this any. I mean, next to the Chermside shopping centre, the proximity that you have to the city, I wouldn't be letting go of this if you have it.
Oh, lovely, Jane. Thank you so much. I mean, that was my thought, but it's always nice just to hear someone else's opinion.
Okay, Belinda, thank you for joining us.
Thank you, Jane.
Okay, got a question from Zane. Zane, it's Jane here. Sydney has seen some impressive capital growth over the last 2 years. The market was dominated by investors and many owner-occupiers have probably overspent on purchases. Would you consider a renovation strategy still plausible in this inner city market? Ooh. Once again, Zane, Sydney is made up of many, many markets. And if you're going to say inner city, I would be staying away from any inner city capital city markets at the moment. And inner city, we're talking CBD. So if you're talking Sydney as a market, there has been growth. There has been frenzy of buying. However, we've seen in the last week an incredible drop in the clearance rates that's been associated in Sydney, and there's been a reduction in consumer interest. We had the RP data report out last week that said in the quarter up to the end of December there'd been a drop of like 2.3%, but in January there'd been a rise of 0.5%. So there's been a small rebound as well and interest. Look, we've looked over the Sydney with Jacob, and I've done some dot map analysis on Sydney itself. I still see some areas of potential there. I know that last year people picked, I think it was Katoomba, that had some amazing growth. The areas around the new Badgerry Creek airport is going to have some sustained growth. And unlike some of the things that we've seen in Queensland or Western Australia and Northern Territory with big infrastructure builds, where there's a lot of people during the build cycle and then they leave, the airport there's going to be a large employer as well, and employment drives the economy and drives property prices. I still think there's some really good areas to invest in Sydney. I think Harry from for Immersion bought a huge block of area on Monday for apartments in Mascot. Now, I'm not necessarily saying buy Mascot, but I'm just saying if you look at that ripple effect, and when I do my dot maps, I'm looking at the affordability, but also the ripple effect. We've got that opportunity where you can see the next areas. So, yeah, I think that there's some real opportunities to really locate the properties and find them. I mean, I know people are saying the same thing about Melbourne at the moment, and at the end of the month I'm running a workshop on finding the best properties in Melbourne and locating them, a one-day workshop on doing that. And a lot of people think that there's no opportunities in Melbourne. I have to say, I can definitely see them. So I hope that helps, Zane. Okay, Lindy, I see you've got your hand up. We're having some microphone's not green, it's brown. So I'm going to mute you again, and we'll see if we can find someone with their hand up. I've got Isaac, who has got a written question. It says, how do you know which streets within a suburb are better than other streets? Isaac, this is a great question. In actual fact, I put a whole module in my Your Property Success Club tutorial around this, and this is using the census data to understand where the owner-occupiers live and where the investors live. Now, you just saw the analysis that we did for Belinda on Kedin, where we could pull up where did the owner-occupiers and where the investors live. So rather than going through huge tutorial and learning about how to do that yourself on census, Jacob and Ripehouse has actually applied that data, and as you could see, we could really very quickly turn on a toggle and say, where do the renters live? Where is the congregation of renters? Now, that information comes from the census data. So, we're waiting in anticipation to it coming out again early next year. But for now, you can actually determine where it is. And if you have a buy and hold strategy, and you want to rent that property out, then you do want to target the streets where the renters want to live. However, just be really clear on this. If your strategy is to maybe buy, renovate and sell, so a flipping strategy, your target market is where 70% of the market is, and that's owner-occupiers. So you need to know where the owner-occupiers live. So knowing the streets within the suburbs and getting all the way down to that is critical for your strategy. So know your strategy first, and then you can work out where to buy. I am going to open the line on someone at the moment. Let me choose someone. Saw. Hello, Saw. Do you have a question? No. Okay. I am going to see if Scott, if you're available with a microphone. Hello, Scott. Hey, Scott. Yes.
Hello.
Hey, how are you going?
Good. How are you?
I'm good. I'm good. How may I help you?
I just had a question in regards to the Gladstone area. I purchased up there off the plan. It's all built and everything sort of went fairly well. Obviously, it's had a bit of a dip in the market. I did have it. My last tenant left on the 31st of December. Pretty much went the whole month of January. I have a tenant secured for February.
Great.
But I did purchase it with the view that, you know, some of the world's top 10 projects are based in Gladstone, or at least one of them, and, you know, the FIFO and all that. But obviously with the investment and the fall of the commodities market, things, and an oversupply in the Glen Eden area, which is where I purchased, it's obviously a bit flat. I just sort of thought I might get some sort of a view either with this great device Ripehouse, by the looks of it, which I've seen tonight, or and your own thoughts.
Look, Gladstone is really difficult to anticipate what is going to happen there, and I'm just going to bring up Ripehouse and bring it over, and I've had clients there, and I've had clients that have had the off the plans that, you know, are worth a lot less than what they committed to when property was built. And I think the biggest issue there, and I'm just going to zoom out because I imagine that area that you're talking about, Glen Eden, is actually out the town rather than prime Gladstone, isn't it? Where are we looking here?
Yeah, it's a little bit. I think it's west. Yeah.
So I think
not too bad. It's like it's still within the Gladstone. It's not far from Gladstone CBD.
Okay, so are we talking West Gladstone?
It's, yeah, I'm just looking at your map there. Yeah.
See, the problem with...
Can you,
So, yeah, what do you want me to do?
oh, I was just going to say, is there a thing you can put in Glen Eden, and it will zoom into the area?
Let's see if we can do that.
But that's why you were looking at that. Also, I was just going to say, it's funny with that last people with Kedin. I've also got a unit 5 minutes out of Brisbane CBD in Kelvin Grove.
Oh yeah.
And that was also unrented for about a month. And that's in CBD, so it's a really fluky market.
Yeah, there's some strange things happening up there at the moment. We've just Glen Eden's come up here, and the fact that it says Kiora and we've got North Auckland, obviously some Kiwis did some planning around Gladstone. So yeah, so we're looking what's that? Southeast. I think that what we've seen in Gladstone has been the fact that we have had those LNG projects. They, there was, I was reading environmental impact statements for them back in, 2006, 2007, and the estimates of what the population growth was going to be. Back in 2004, 2003, I was a mining engineer that, had a popping plant up there for explosives that I was up there all the time. We could never get accommodation. We had, workers in 5-star motels. But so there was that real demand, and there was opportunity that came from that. And there was a lot of developments and a lot of out-of-area development. So not CBD, close, but the new estates. And that's where a lot of people did buy that off-the-plan type of properties. I guess the thing is that, and I even was reading in the Fin Review yesterday, there was a brand new mine project in Queensland that's just been approved. And and I was talking to a guy from the gasworks down here who had worked up there, and there is that underlying, it's almost going to happen again. But for the meantime, we still have, if we just pull up there, what we're seeing with some of the vacancies. So let's just have a look at.
Yeah, there is a lot of vacancy up there at the moment. I did do, I basically, when I put it on the market for rent, I said to my property manager, look, don't put a price on it, just get the people in to have a look, and if they want it, go off the market and gauge their opinion. And we came to an agreement, which was, I guess, not necessarily in my favour, but at least it's better than being empty and not offering weeks free rent, etc., etc.
Exactly. You can see here the vacancy in Glen Eden is 3.58%. So really, when we're talking about equilibrium in the market, we're talking around about, as consensus is around about 3%, which means there's as many people looking as people who want to rent. So 3.5 wouldn't necessarily concern me. If that started trending upwards, it would. I'd be trying to lock your current tenants in for longer. Well,
the problem is they're mainly all like you would know, they're all on contract, so you can't sort of lock them in if they're there with a contract base.
Exactly. Well, we see here vacancy rates here in Kirkwood, 15%. I'm not seeing any properties in this area, so I'm not too sure if that is a brand new area or if there's hardly any properties there at all. Talina, 2.9, and I assume that as we get closer to town, we would see those vacancies get lower. So, in West Gladstone, we're looking about 1%, etc. So there's definitely not as many, the demand that's in that area. If you've got and the problem really, and I'll take this away from Gladstone, but just make a general comment about, those house and land and new development areas. And, we see them in the western population growth of Melbourne at the moment, Tarneit out there, Point Cook years ago. The developers are actually creating those areas, and there's often nothing that's really differentiating your property from the other properties in the area, and they've all been built at the same time. So, you kind of have to create it if it hasn't been created already. And, as we talked about, earlier, it might just be making it pet friendly, or it might be, having it furnished or having foxtel. I worked with one of my clients was just frantic because he hadn't rented his property for a long period of time in a mining town, and we kind of brainstormed what he could do. And by the time we talked about adding in foxtel, he had more. The agent rang up and said, "Oh my gosh, we've had more than 5 times people looking at your property over every other property." So trying to work out what the typical tenant wants and potentially satisfying that need as well. So I'd be trying to get a long lease if possible, but commodity prices and the market and etc. of what's happening, it's when you have to come back to say, well, is this eating up my borrowing capacity and is it worthwhile selling or not? And only you, after you've done your analysis on that area and work out what's the drivers of the area, in particular that suburb, if you work that out. I'm always loath to sell, but if a property's not doing what it should be doing, and it doesn't look like there's any hope that it's going to, you may need to make that evaluation.
Yeah. Okay. Thank you very much.
Hey, thanks, Scott. Bye-bye. I've got a question from Sandeep. He says, I've got an apartment 8 kilometres from CBD where there's a lot of new apartments being built. Should I be selling? So I'm gathering, Sandeep, that your apartment is... and if you're still there, I see you've just noted this in chat. Can you just tell me the suburb and city that you're in? But one of the things about new apartments is that if your apartment was new and there's not a lot of tenant loyalty, then and there is a large tenant population in the area, then what I would do is I would be doing an evaluation to say, well, if I've got a 2 or 3 year old 2-bedroom apartment and there's 1,500 brand new 2-bedroom apartments going up, is this going to affect my vacancies and what I have in my rental return? Now, if it's a growth area and there's growth drivers and there's a large group of tenants that want to rent in that area, and they want to rent the 2-bedroom apartment, then the demand or the development demand might be just filling that need. And there, you'd see that from the vacancies at the moment. There would be, hardly any vacancies. I have concerns. I mean, I've got a property that's essentially the size of a unit near Camperdown in Sydney. There's a lot of units going up there, but they're brand new units, and I have an older style property with character that allows people to have just something a little bit different, but still have that 2-bedroom apartment type living, but in the close proximity to the city. 8 kilometres out from a city and having an apartment there is unusual, and I would have assumed that the typical property for that area was probably a 3 or 4-bedroom house, depending on what city that you're in. So, the fact that you've bought out there in what I'm assuming is an older style block, you probably did your research to work out that there was the demand there. If you went into the census area, I can see you haven't told me what area you're in, so I can't do it for you. But if you go into census and you type in census.gov.au, and I'll have a suburb search, type in the suburb. If you get to dwellings, go down and have a look at what the typical dwelling is, what percentage live in houses and units. And if you've got the typical type property for what people want in that area, I wouldn't be so concerned. If not, then I would start thinking about, is this a worry or not? So, and anticipate, once again, as I said to Scott, anticipate whether the property still fits into your strategy and when you want to achieve it. So, okay, guys. Oh, my goodness, we've got about 10 minutes left. Let me see if I can get some more questions done. Sally, what would you consider to be an average annual capital growth? Oh, Sally, good question. And I'm going to precursor this by saying that if we look at capital growth in the last, let's say, 12 months in Sydney, I've got a property in Sydney that went up by 25% last year. That is not typical capital growth. I have properties that most of my properties went up by 17 to 25% last year. not typical, great year though, and I'm happy to bank it. But the reality is that you can't anticipate that, and what we're hearing is the market is going to come back somewhat before it goes back into the next property cycle. We had a look at that property cycle, the property clock on Jacob's website earlier this evening, and it's around, and I guess, anticipating what long term is. Now, the most data that you can get from the back of Australian Property Investor magazine, Your Investment Property magazine, is 10-year past growth. However, once again, I referenced founder of Residex, John Edwards. When we sat down and had a chat about it, he had said to me, look, you need to look longer than that, and 20 years would be a better determination of past growth. However, it's when you're actually choosing that 20 years, right? So we have had a couple of booms and peaks in the last 20 years. So we're trying to aggregate that. So the longer the better. And actually Ben and I had a similar conversation about this, and he's always looking for the 20-year growth as well. The thing is, 20-year growth has been around that 7-ish %, and that's why you hear people talk about average growth of 7%. But the thing is, incidentally, it's similar for the last 20 years of interest rates as well, just for a bit of trivia. But so the thing is that it doesn't mean that you're going to get that every year. But if you have a long-term strategy to buy and hold your properties, and you anticipate that and you try to predict that through maybe using my dot map technique or the ripple effect or the demand curve or income growth or whatever the determinations are that you use to try to anticipate what the growth's going to be. I buy Residex reports for suburbs, and they do a 5-year and an 8-year predicted growth. Is it money in the bank? Can you back it on it? Look, it's one tool in the toolbox, and it's one consideration I have. And they go through and do infrastructure studies and information, and we're always looking for that. So, I hope that helps. But when I'm kind of looking very long term, I'd be using an average of 7. Okay, I'm going to see if we've got anyone now with their hand up with a microphone for a couple of last questions. Wayne, how are you?
Hi.
Hey.
Am I on? Okay, cool.
You're live.
Hi. Yes. So I might have missed out the first half an hour. So did you guys discuss the top location in 2016 or where to look for and things like that already, or?
Oh, Wayne, you've just missed out completely. Lucky, I think okay. I might have to try to record this and get this out to you tomorrow, because I've got a lot of questions here of people going, what was that shot? But Wayne, we've spoken in the past, so I know Wayne quite well.
Worries.
Yeah, but Wayne, have a listen to it. There's I guess the key message that I took from this evening is understanding the dynamics that are going to drive the growth for 2016. But also, we did jump into a little bit of detail and go through the states and look at areas that have the metrics and considerations that the Ripe House analysis tool has indicated have potential for growth. So go back there and have a look. Yes, because I think some of the conversations we've had in the past, I think you'll find some good areas. Thanks,
cool.
Wayne. Yeah?
Just a quick question.
Sure.
With the Jacobs website, is it similar to the .met system, or there's some extra things you guys would find more enhanced on your .met system than Jacobs websites, or they're pretty much the same? Or
no, look, it's a really good question. I have an entire system that I use, and I start with the map. And for those people who don't know the map reference, it's essentially getting a map and getting some dots and plotting 1% increments of capital growth over the last 10 years and looking at that ripple effect. So, the whole system allows you to start with a suburb overview, have a look at where there's anticipated potential growth based on that ripple effect, and then getting down and doing suburb analysis. Now, I use a lot of tools to do the suburb analysis. An actual fact of the workshop that I'm doing at the end of the month, we're going to be pulling out some of the stuff that Ripe House uses, Residex, and a lot of other tools, actually, so to get us down to a suburb, and well, we're going to go and have a look at a house. So, we're all within one day, from a city to a suburb to a house. So it is one tool, and it's a fabulous tool that I use, but it's just one tool in the toolbox.
Perfect. All right. Thanks. Thanks,
Okay.
Jane.
Thanks, Wayne. Okay, I've got a question here from Troy. I'm turning 50 this year. Congratulations. And have been looking to invest in real estate for the past 18 months. Have I left it too late to start investing in real estate, and will the banks want to lend to me under the new rules? I own my own home in Brisbane. I owe very little. I've got through a line of credit that you have, $600,000 property, 120. That's it. Fabulous. Troy, no, it's never too late. In actual fact, I have clients that are a lot older than you that have started investing, and the fact of the matter is that concerns me you've been looking for 18 months because the market has been kind of cool in the last 18 months. However, as you've seen this evening, there is still opportunity. Look, I'm going to put my mortgage broking hat on now. The APRA changes and ASIC-led changes that came through in June, July last year have led to two main things, and that is banks' responsibility and how they assess your debt now and how it's going to affect you in the future. And obviously we've seen interest rate rises due to the fact that they've had to hold more capital. And essentially APRA wanted to reduce investor spending to below 10%. To some degree that's been done in the recent figures that I've been reading today and yesterday. But I mean, the reality is at 50, you're going to be taking a 30-year loan. So, do you plan to be working when you're 80? And if you are going to need an income to pay for your loan in 30 years' time, the lender's going to look at that. The good news, though, is that if you come up with an exit strategy, then the exit strategy is, hey, I plan to pay down these properties, and I then want to pay off the loans. So as long as you've got a very clear exit strategy, that's what the lenders kind of look at. The fact you've got so much equity in your home and it's not like you're putting everything on the line for this investment, it gives them reassurance. The fact that I imagine, at 50, you've had a career and some income that has allowed you to pay off your home, and that allows you to have the borrowing capacity that they want. Borrowing capacities have reduced. I'd say if you don't have any other debt other than the 120,000, and you have low other personal debts, credit cards and personal loans for cars, etc., then there's no reason why they wouldn't look at where you buy. The key to where you buy, though, is your location, because your time frame is going to potentially be shorter than other people. But one consideration you might make also is buying in your super. So there might be some opportunities for you to buy there. But no, not too late. Sorry, hope that helps. Okay, I'm going to unmute the line. Lee, I've got you there. Hey, how are you?
Hi, can you hear me?
I've got you. How can I help you this evening? I think you're my last question.
Oh, thank you very much for fitting me in. This has been so informative. Thank you. I fully own an apartment in the Kensington Bank area, and the council there has approved 6 31-storey high-rise apartments to be built close by the race course. I'm just wondering whether it's whether you have an opinion on whether I should sell or leverage it to buy something else somewhere else.
Tell me, I know I actually used to live in Kensington. In the Kensington Banks area, there's some higher units, but how big's the block that you're in?
It's a fairly big block, but it's not high. It's only got about 10 stories.
Okay. I guess the thing is 6 31-storey apartments is considerable, and it's probably going to block our view of the races when we go over the river from now on. But I think it once again comes back to kind of the conversation that we had previously with Sandeep, I think it was, about the risks associated with what is going to drive that tenant demand in the area. Now, we're talking very close proximity to the city. We're talking great infrastructure. We're talking, lifestyle, village-type atmosphere as well. The Kensington Banks almost is a microcosm of that. You have that kind of community going on as well. So it always has had tenant appeal, and it's and I would say that if your property was the typical property for the area, like a 2-bedroom unit, if that's what the type of units are, then there's always going to be demand for that. the fact that there's going to be thousands of units come on the market, and I'm assuming we're talking some years in the future, right?
It's on the current council plans right now and has been approved. So, yeah, but it's kind of the other side of the race course. Yeah.
But about 2 years away, construction and completion. Yeah. So the thing is, if you have significant concerns of the fact that there won't be demand for your property once those properties come about, and your property isn't much different to those, like you're in a 10-story building, and the only difference is kind of the view from the top rather than the fact that you're on a single smaller block that you have a garden or something. You don't have the large strata fees associated with the lifts and the pools and the tennis courts. Then if you have that kind of a little bit of a niche, then I'd say I wouldn't be that worried. But the fact that there is so many units coming about is something I think you've legitimately raised as a concern. That area is a fabulous area, and there's as I said, the proximity and the income growth and all the things that drive that area have, I guess, put it on the radar for these developers. But my concerns would be, will you have the vacancy issues that we've spoken about with other people this evening when there's a flood of the market?
Yeah, because at the moment there's no problem with the vacancy issues. However, in the future there may be.
Yeah, absolutely. So it is a concern. If one consideration is the fact you have a property there and you're looking at the future of that property. Another is for people buying a property there, that there would be real red flags about the potential units that are being developed there. So if you're looking to buy a unit rather than a house in the area, then I'd be, and going to buy there, I'd be really concerned. And it brings up a good point that the information is on the council website. It has been approved. So people who are looking at the areas, when we just talked to Wayne and said there's so many different things that you have to look for, and what I do in my system is I try to look to all these things, and going to the council websites and finding out what the development plans are is a key to that, because you want to know. And I know people who've bought fabulous properties, and 3 months later, all of a sudden the house next door got knocked down and there's townhouses and building going on for the next 12 months. And it was on the council website. It was approved. They just hadn't done the research. So it's a good place to start looking. So hope that helps, Lee.
Thank you very much, Jane.
Okay, all the best. Oh, well, guys, it's been an epic evening. And look, before we conclude, and thank you to the hundreds of people who have stayed. We didn't expect to have so many questions, but I really appreciate it. And look, I want to let you know, as I mentioned a little bit earlier, I'm going to spend a full day with a small group of people working on locating the best investment suburbs in Melbourne very soon. And you can take that learning and apply it anywhere to suit your individual circumstances or area. And, as you know, I've done a lot of online coaching. I'm used to talking at larger events. So this is going to be quite unique and a great opportunity to work with you in person. So, look, during that day, we're going to go through my whole process. We're going to identify suburbs in Melbourne, showing the most potential, the streets where your search should be concentrated. And we'll be actually learning how to inspect a property with a walkthrough of a property on the market at the moment. And because this is such a small group, it gives me the opportunity to, really go deep on this important topic, and, with lots of one-on-ones with you. And I'm going to be working with you on identifying suburbs that you can apply to your own personal buying criteria, identifying the pockets of potential within those suburbs, and then how to conduct the property inspection itself. So look, this is a collaborative workshop designed to fast-track your property investing by introducing you to my proven suburb selection and the suburb due diligence method that we've been talking about, and using some cutting edge software. Look, it'd be really great if you can join us, and I have to kind of apologise up front because it really is strictly limited to a very small number of people, and because I really want to focus my attention on the participants and give some one-on-one time, just so that I can give the extra effort to this really important topic, because I think it's something that people miss, the importance of the location. And as we've learnt tonight, there's so many considerations you need to take into account. So I want to make sure that people walk away with the tools to take action immediately, and hence why it is such a small number of people. Now, look, if you do want to join us, please email me your details tomorrow, and I'll get you some more details. Email me support@yourpropertysuccess.com.au. So that's support. And, I'm just going to pop the link right now into the chat box so you can see that email address. Look, tonight has just been wonderful, and I got to say I am so thankful to our special guests, Ben Kingsley from Empower Wealth and Jacob Field from Ripe House. We really appreciated our panellists taking the time to share their knowledge and analysis with us, because I really think that 2016 is going to be a year of opportunity. And while a lot of people are waiting around saying they think the market, anticipating what the market's going to do, those who are ready to take action can. So once again, I really want to thank Jacob also. He's offered a free trial for 14 days of the Ripe House software to new users of Ripe House. So go to ripehouse.com.au to /sign up. You can see it there. Put in my coupon code, which is YPS 2016, and for those new to Ripe House, you will have 14 days free software that you can interrogate some of those things that we've seen tonight and all that new functionality that came live yesterday. So there's some amazing new things there. Look, I just want to thank you guys also for hanging in there for so long. I know that there's so many questions. We had a bit of frustration with people's microphones, and we'll make sure people have microphones turned on in the future. But look, great questions. Thank you so very much. I really appreciate you being so interactive and being so engaging. I really enjoyed this evening. And until next time, goodbye, and wishing you your own property success.